All right, the next bill for our consideration is Bill Draft 20 LSO 88, reporting of gross receipts. Who's got that? Who's got that? Josh, why don't you do that one?
Oh, you did. Got it.
Okay, Mr. Chairman, Josh Anderson, LSO. This was a bill we looked at a couple of years ago when we were talking about the idea of doing a gross receipts tax or some type of corporate income tax, and being able to gather that information. Discussed briefly at our last meeting up in Lander, and asked to bring it back. So it's basically exactly the same as what it was last time. It requires companies that are required to file with the Secretary of State's office to file additional information. You can see it there on page 2 of the bill, what information they're required. It's total gross receipts reported on their federal taxes, the portion that was earned in Wyoming, their home state, and then their NAICS code classification. It does say that that information will be kept confidential, other than the Secretary of State would then report aggregated information to the Department of Revenue and to this committee for the purpose of determining potential revenue sources. That gives them rulemaking authority. I would note, last time we did it, it was a 2-year delay, so that it's currently wouldn't go into effect until July 1, 2021. That can certainly be open for discussion, and maybe the Secretary of State's office would have more to say about that. But that's pretty much the bill in a nutshell. It's pretty straightforward.
Thank you, Josh. Any questions for Josh? Any questions? Thanks a lot, Josh. Secretary of State's office, move on deck. Mr. Secretary, welcome. Ms. Wheeler.
Thank you, Mr. Chairman.
Thank you, Mr. Chairman.
Mr. Chairman, members of the committee, I just wanted to, since this is one of my first interim meetings that I've attended, and with regard to the gross receipts, so just wanted to kind of let you know that we're here to facilitate this piece of legislation to the extent you think it's appropriate. We have a few things we'd like to maybe point out or ask you about, maybe some items that you might consider as you go forward. If you move forward with this piece of legislation, we have some things we would just like to speak to, so that you're fully informed as you go forward with this, and just let you know that I'm here to help in any way I can in drafting it or whatever your pleasure is. So.
Okay. Any questions at this point? Why don't you go ahead and dictate your concerns?
Sure. And they're not necessarily concerns,
Okay.
Mr. Chairman. I want to be clear about that. It's simply items or areas that will highlight that you may want to consider or contemplate, certain directions you may want to go. And one of the first things that we had seen is, and you're probably aware, but under Wyoming statute 1729 or 1716, 1630, that's your profit corporations, but you're also kind of sweeping in with that your limited liability partnerships and your registered limited liability partnerships. And really, that's just something we need to know, or you might want to know yourself, whether or not you intend to sweep them into this as well. As you know, you're looking for purposes, if you're looking at revenue, you're probably primarily looking at profit corporations and limited liability companies. And so we just want to ask the question, or have you consider whether or not you're also meaning to sweep in the limited liability partnerships. And that also kind of goes to another part of this when it comes to implementing this particular piece of legislation, because if you do intend to sweep more entities into this requirement of gathering their gross receipt information, that goes into our analysis as far as changing our online reporting system. I know you're aware that that's been very successful. It's kind of a big revenue driver as well. 95% of our annual reports are filed online. And so we would have to change that reporting system, and depending on how many entities you ultimately want to include in this legislation, will drive some of the changes we have to make to our online reporting system. The other thing that I had a concern about, and it's really not just limited to this piece of legislation, but it's always been something I've wondered about, is an enforcement mechanism on this. As you know, the current worksheet that you have, you're $0 to $250,000 in assets, flat fee of $50. We don't have a mechanism. I'm not saying we want one, but we don't have a mechanism really to go out and make sure that you're getting necessarily accurate information. People attest to these. I believe that it's true and accurate, but I don't think it's anything that's got a great leverage, if you will, when it comes to accurate or honest reporting. Not suggesting that anyone would ever underreport the value of their assets, but when you're talking about a piece of legislation that you're wanting information, perhaps as a revenue generator, it's one thing I've always wondered about, and I'd like the committee just to think about that and just whether or not there's some type of enforcement provision or some way to make sure that the information that you are asking for is accurate, because I can imagine this would be an exercise in great futility if that doesn't happen, because you need the information so that you can make an informed decision going forward. I'm imagining on a lot of other things, given the fact that you're the revenue committee. So good information coming in gives you good information to do your work as a revenue committee. And so those are my primary issues that I wanted to bring up. We are thinking that depending on, again, how many entities you want to gather information from, back in 2017, I'm told that we kind of looked at this. So we have some preliminary numbers as far as a cost that it might require to update the online reporting system. And we can go into those, but for now I'll pause for any questions, and then I know Deputy Wheeler has some things that she wanted to bring up as well. And she was just mentioning to me, one of the other side pieces to this is, you have a lot of these entities who are administratively dissolved because they haven't paid their annual reporting fee, and there's a grace period that go beyond that, they get dissolved. Then there's a reinstatement process and a fee. And so for a lot of those that remain administratively dissolved for quite some time, another question would be, do you want to reach back to those? If this were to go into effect, would you want to kind of claw back or reach back to require them to provide the same information? Let's say, this passes, 2021, and then you still have, 100 companies, I'm just making that up, but in 2023 that have still been stagnant, they're administratively dissolved. If they reinstate, do you want to claw back that information for the last 2 years that this law would have been in effect to get an even more accurate picture? And that's another piece that we would have to think about on how to make that happen for you. So that's the last piece that I have, and then Deputy Wheeler, feel free to comment on anything else, or we'll take questions at this time.
Any questions for the Secretary? Mr. Co-Chairman.
Thanks, Mr. Chairman. So make sure I understand what you're asking here. It's on enforcement or auditing. When they turn in annual reports, you have right now a mechanism to review some of them and audit or check. You foresee a different process, or you were asking for like an additional position or something can you do it the same way you do it now, depending how we how we read this, it's just asking for more information, whether or not that's true or accurate. Is that different than all the other information they provide?
And
Mr. Secretary.
Mr. Chairman, Mr. Co-Chairman, no, I don't foresee necessarily doing it any other way than we've been doing it.
Okay.
But I just know because you're gathering information here that isn't just for, at least in my mind, and point out if I'm wrong, but it's an information gathering piece that will give you a lot of information for several topics, probably in the future for a revenue committee. And I just wanted to raise the point that the information will only be as accurate as what people will give you. I'm not suggesting at all that I need any other enforcement mechanism. It's just something I wanted to put out there because it's one of the first things I thought of when I was thinking about what this type of information would be used for. And again, if you don't have good information coming in the front side, you won't have good information to make decisions. But none of us sitting here can predict whether or not it will be any more accurate than it has been in the past. So that's all it was about.
One follow-up then?
Absolutely, Mr.
So on the current forms, they swear or affirm, is it criminal penalty or civil penalty if they're caught misreporting? And would you foresee it being the same penalty if we did catch for some reason that misreporting this information? What's the current punishment?
Mr. Secretary. Ms. Wheeler,
Thank you, Mr. Chairman. Karen Wheeler, Deputy Secretary of State.
we got to speak up because
I'm sorry.
we don't have a microphone and people have been complaining in the back. But
Thank
not
you,
about you, just about.
Thank you. Currently, under our statutes, to file an annual report, we have authority to go in and look at the books and records, and I believe they have to keep those, 3 years. We have the authority to go and look, but we don't have the then what authority. Can we issue sanctions? Can we ask for the collection of the tax that they didn't pay? So we have authority to go in and look, but that's all we can do. And that is for the annual reports that they have to pay their tax on. So I don't know as though we would want or would even be able to have the authority to go in and look at tax returns that this information is pulled from. So that is our current authority right now. And Mr. Chairman, if I may, just real quickly, to talk about the reinstatements, to modify our system, I'm looking more at the entities that were administratively dissolved 2 years prior to the effective date of this act. If you want us to collect that information from the 2 years prior, from those that are trying to reinstate, we would have to modify our system just a little bit differently. So we'll need guidance on that as well.
Anybody else? Representative Sweeney.
Thank you, Mr. Chairman. Will it take a lot of modification? I'm trying to remember back 3 years to the system as it is now. If this were enacted for collection, it seems to me there was going to be a cost associated with gathering this information and changing our forms, but I can't remember exactly how that went.
Ms. Wheeler.
Thank you, Mr. Chairman, Representative Sweeney. So yes, there is a cost. I can tell you a range is from $82,800 to $100 and almost $118,000. And we will need guidance on some of this to really drill down on the final fiscal impact. So number one, as Secretary Buchanan mentioned, are you wanting to capture, so we have 8 entity types that file annual reports. Are you wanting to capture the 4 that are tied into this bill? Are you wanting to capture just the 2 main ones, profit corporations and LLCs? So those will require different modifications. And then we go into the reinstatement question as well. So once we have guidance on where you want to go on those 2 areas, we can get you a more finite fiscal impact number.
Follow-up. Mr.
Absolutely.
Chairman. Thank you, Mr. Chairman. So in yesterday's conversations on wind tax, in looking at New Mexico in particular, they're taxing, utilizing gross receipts tax versus a production tax. And it seemed to me that looks a little fairer going down the line, both for the state and for the actual developers. So this is pretty timely, I think, in those discussions. In my mind, I wouldn't see going back, just myself if this moved forward, but on the dissolved companies, I think that'd be too burdensome. But going forward, I would see it more for the for-profit. And I don't, I just wanted to make sure that it wasn't going to be totally out of range, like a $2 million, number to totally revamp the system, which doesn't need revamped. I mean, can we plug a module in or new programming? But the couple 100,000 range doesn't seem out of line. So
Mr.
I don't
Secretary,
know if there was a question in there or not.
I think you said, could we plug a module in? Can we plug a module in, Mr. Secretary? and Ms.
I'm not
Ruth?
sure exactly what that means. I will say this is the numbers, that's very accurate. And what you said, Representative Sweeney, is that would, if you didn't claw back on those companies that had been administratively dissolved, and depending on how many entities you include, you start getting to that lower range that Deputy Wheeler gave you. Those numbers are a couple years old, but they're fairly accurate because they're from the design folks who do our system now or maintain our system now. So it's a pretty good solid range, I would tell you. So when you say, $200,000 or less, I think the numbers that she gave you are very accurate for those reasons.
Representative Conley.
Thank you, Mr. Chairman. And I'm hoping we can bring Director Noble up to kind of help answer some of these questions and concerns that you have. Because in all honesty, my recollection of this bill came about because of both the frustration of the committee and with the director with the questions that we were asking him about kind of the amount of revenue that corporations were earning and the NAICS codes that are associated with it. And the honest answer was, we don't know. And I think kept on telling us about your guesstimates. And so this would help us to get that information. It's readily available information to all corporations. We just need to gather it. They're already reporting to the feds. They might as well report to us. But you would have to collect it. And you have some good questions. So I'm wondering if we could ask Director Noble to come up and maybe help out with some of the answers. Because I like Representative Sweeney. Don't see any reason to go backwards. But I'm curious what the director thinks.
So Representative Sweeney, I'm sorry, apologize. Representative Conley, let's see if anybody has any other questions for the Secretary of State's office, and then they can all three sit up there if they want. Any other questions for the Secretary of State's office? Any? Okay, well, it looks like you got called at the right time, Mr. Noble, welcome.
Thank you, Mr. Chairman. Members of the committee, Dan Noble, Director of the Department of Revenue. You're right, this process was designed to actually provide to us with some data points that we don't currently have available to us. We don't know how many C Corps are actually out there that would actually meet the thresholds that we're talking about. And we don't know, how much of their revenue is Wyoming revenue, which is critical to this exercise. There is one component of this that is missing, and it's critical because of our constitutional requirement for offering credit on taxes. We would need to know how much in sales and property taxes these companies have paid, Wyoming sales taxes and property taxes. And The reason for that is because we would have to back that out of their taxable income and then reapply it as a credit against the taxes that ultimately end up being owed. So in order for me to give you a number that is going to approximate what we could expect to receive, I probably need that number in addition to that.
Anybody else? Mr. Co-Chairman.
So thanks, Mr. Chairman. So I would suppose that every corporation would have that information readily available, their sales tax and property tax. That's my first question. This isn't a burden on a company because this information is readily available. My second question is, I'm probably going to put you on the hot seat here. The best place to submit this information is along with their annual report that goes to the Secretary of State. There's no reports or forms in your office that we would ask the Department of Revenue to collect this information with other information you collect. The best way to, in your opinion, to do this is to have the Secretary of State collect this information and then turn it over to you, or you can publicly review if you should even want to ensure that they're reporting correctly.
So, Mr. Noble, you definitely get a shot at the question, but I'm wondering if I could tag on the co-chairman's questions. You mentioned that I think for property tax, it's pretty easy for a company to decide that. You basically make one check or whatever. But sales tax you pay out in all different ways. I think that's a little harder to track, but maybe there is a way. It also strikes me that, Mr. Noble, with respect to that request, these entities are paying it to us. So the local governments have the property tax record already. Why are we going to make them do it again? But I'll throw it back to you. It's meant to be a tag on.
Mr. Chairman, Co-Chairman Case, and I think the real concern I have here is that this is an allocation process. When you look at what happens at the federal level, they report on a line, I think line 7 of the 1120, what the taxes are that they're claiming as deductions. They don't tell on that form how much of that is property and how much of it is sales tax, how much of it might be income tax from a previous period. Any of those things are aggregated into one line. And so there's only 2 of those taxes that actually would apply as a credit, and that is their ad valorem taxes to the state of Wyoming and their sales taxes to the state of Wyoming. Not all of the taxes that are reported on that 1120, just the taxes associated with their obligations in Wyoming. And that's not necessarily how this tax works in some states. These deductions, and what they report is their portion of the income that is related to a specific state. So all those deductions have already been taken. Doesn't necessarily mean that only, the same percentage of the deductions are related to Wyoming taxes that have been paid. It's all taxes that have been paid. So once we identify who the taxpayer is, we can certainly look to see how much they paid in property taxes by checking with the local government to find that out. But on our reporting form, we're going to be asking them to declare how much in taxes that they paid associated with Wyoming, and then we're going to take that and add that back into their taxable income because it's already been deducted. And then we're going to take that same number, and once the tax has been calculated and their net tax is due, then we subtract that from that taxable that tax amount. So that's what the effect of the credit is that it may only apply to 7% of that tax going back into taxable income, but coming back out as a dollar for dollar reduction in their tax. So it's a very big difference in what it does to their taxes. I'm not sure whether that answered the question. Do we have the ability to capture some of this? Once we know who C Corps with more than 100 shareholders are, we can probably look to determine and at least verify how much in taxes were paid by that C Corp. However, that's on property tax side. On the sales tax side, most of the time, they pay it to a purchaser, so we'd have to capture it from them. They'd have to give us the number.
Mr. Chairman.
This is going to be, because I'm new to the committee, Mr. Chairman, but can we go back 10 steps? Why is this information important for the state to know?
Mr. Noble.
Mr. Chairman, the biggest issue we face is trying to estimate how much this exercise in the Retail Fairness Act would actually, how much revenue would generate. Until I know how much those tax credits are, and how much revenue, Wyoming revenue is generated by these companies, I can't give you an answer as to what that is. We've never had to do the allocation or apportionment of income before because we've never had this tax. We need to find that out to really get our arms around how much of that is Wyoming income and how much of that is subject to those credits. To give you an accurate number as to what revenue can be generated from this tax. 7% might not be enough.
Representative Sweeney,
Thank you, Mr. Chairman.
speak up.
With the same concept, if this, I don't know if you could only apply it for wind generation, but would that same data still apply if we were to have this way with a gross receipts tax on wind generation? You know, they would have property tax, sales tax to the developer. Would there be any different information?
Mr. Chairman, Representative Sweeney, I think it's debatable. I mean, it's been discussed in this committee in the past as to whether or not a gross receipts tax would be considered an income tax or not. In its purest form, it is a tax on income with no deductions. Simple as that. But then again, you could say the same thing about a sales tax. It does exactly the same thing. My thought would be, I'm not sure that you would have the same problem with tax credits on a gross receipts tax that you do on an income tax. Now that is obviously open to a legal interpretation. I'm not ready to give you that at this point. We can certainly ask about it as to whether a gross receipts tax would be considered a tax on income and would be subject to the same constitutional provisions or not. I don't know.
Representative Conley,
Thank you, Mr. Chair. And so, Mr.
Chairman,
Noble,
please. Thank you.
can we go back to two of the questions that the Secretary of State's office asked? And one of them is whether we need to do both 1716, 1630, which is corporations, and the 1729, 209, which then includes the kind of partnerships. So that was one of them. And the second one, is there any crucial need to go backwards that 2 years if a corporation dissolves? What are your thoughts on that?
Mr. Noble?
Mr. Chairman, Representative Conley, I guess as far as it relates to whether you're going to capture the types of entities that you're looking for under the, I can't remember the statutory reference, but for just corporations, because there's more than one type of corporation. You have C corps and you have S corps. And I don't know whether S corps are covered in that or whether it's just C corps. Just corporate, so it would be both.
Both.
Okay. The reason that's a big issue is because a C corp is what we're looking for, and specifically a C corp that has more than 100 shareholders is what we're looking for. And I don't know whether you capture that under this exercise at all.
Mr. Co-Chairman?
So if we were not looking at the C Corp 100 shareholders and looking at a broader based corporate income tax, it wouldn't matter.
Mr. Chairman, that is correct. And you would be covering all corporations at that point. Not partnerships, not LLCs, but you would be covering all corporate entities at that point.
One more.
Go ahead.
Would it be fair to say then, if this is a cost estimating exercise, the 2-year window of looking really doesn't matter because we would assume they're not reinstating. And if they did, I mean, that's not going to be enough of a share that's going to make a huge difference in the projections we're hoping to get from this exercise. That'd be fair to say.
Mr. Noble?
Mr. Chairman,
That's why we're doing
I
this.
think it would depend on the company that was administratively dissolved, but I would imagine that the major corporations that you see in this state are probably not going to be administratively dissolved. If they did, the person probably would be working much longer before they reinstated.
Everybody, it seems to me that, I mean, one logical way to proceed on this is that if somebody's dissolved and their dissolvement predates this act, they shouldn't have to provide information that predates this act. If the dissolvement occurs sometime after this act would go into effect, they should only be obligated in resolving the dissolved situation to go back as far as the law applied. And I mean, that would be a straightforward way to handle it. You know, I think we need to hear some articulation of why we want to do this, because if it's about the tax on wind energy, for example, this is like collecting information on everybody to end up with a tax on 5 or 10 things. You know what I'm trying to say? And the same with perhaps on the big box tax, that why do you have to ask the information everybody? Maybe you could go at it more directly. I understand we want to have it up front for estimation purposes possibly, and I can understand Mr. Noble's seeing the usefulness of that, but there may be other ways to get the information as well, and I don't know. I just want to hear more broad-based of why we want to do this. I know Representative Obermueller is here. He's probably not here for this, but I think it did have something to do with him in the past. So let's make room for him. Oh, Representative Ellis, or Senator Ellis.
Thank you, Mr. Chairman. My understanding, and this goes back to when we first started talking about gross receipts tax, was we went through the history.
Mm-hmm.
And my recollection is that states eventually went toward a sales tax model because it's more straightforward. People can see it on their receipt.
Mm-hmm.
But in recent years, it's kind of resurfaced its head. So to your point, I don't know if we're just talking about those industries that provide a certain amount of sales tax to the state, not all businesses. Is that
That's fair enough.
at least
yeah.
one way of narrowing our thinking of this?
Yeah, I'm not sure if it's necessarily gross receipts versus sales as much as gross receipt possibly against income, but I know that Representative Obermueller is here. We'll get him up. Do you have a question? Representative Conley, please.
Thank you, Mr. Chairman. And just to Senator Ellis's question, I also think we were curious about, for example, the value of services.
Mm-hmm.
And we really didn't know. So it wasn't just about sales and gross receipts. It was also about all of the issues that were coming before the committee, including taxing on services. And we honestly just didn't have the data to know the answer about what the value of those services might be if we're to think about a taxation. So it was a lot.
There it is a lot. Anybody want to comment on that?
Mr. Chairman, Representative Conley, if the goal of this process was to capture how much we have in services, I can think of a lot of very large entities in the state that are neither corporations or even LLCs. They're professional partnerships. Accounting firms come to mind, a lot of legal firms that may or may not actually even file with the Secretary of State's office as it relates to that type of an organization, and they may not even be covered under what it is that you're asking for. So if you're looking for that kind of data, we'll come up short because we probably won't capture the universe of all those providing services by doing that, going through this exercise.
Fair enough. Is it okay with everybody if we pull up Representative Obermueller and ask him a little bit more about background on this?
You guys can stay seated, I'll just stand off to the side. What happened was in,
We have to speak up for the people in the back, and I know we're
what
not
happened was in
doing
the
very good.
spring of 2017, a gross receipts tax was on the agenda. And as we went through the process of looking at what that might do, we had Dan Noble present to us. And he discussed his limitations of the information. And so the idea, this was the only bill that came out of that discussion. Because the thought process was, okay, we're getting out ahead of this gross receipts tax itself. Let's find out what we're talking about. And that was the genesis of this bill. And then it didn't make it through the first time because some people didn't want to know what we were talking about. So it didn't make it. So that was it. That was the bill that came out of the gross receipts tax discussion. So the idea was to gather information so that Director Noble could do some analysis and help us understand the environment that we're in. Thank you.
Questions for Mr. Representative Obermueller? Question? So Representative Obermueller, if we don't pursue the gross receipts tax, is it still valuable to do this?
Personally, I think in light of the bill that I'm bringing on corporate tax, I don't see that has a great nexus with that. It seems to me that was designed to lay some groundwork for gross receipts tax, which I don't see in our future. We've shifted to what the bill that I'm going to present. So I don't really see a lot of value in this particular bill in the context of what I'm working on now.
Okay, thank you, Representative Obermueller. All right. Would anybody else like to testify on this bill? I'm sorry,
I'd love to, Mr. Chairman.
Mr. McKay, welcome, thank you.
Thank you. Mr. Chairman, Lawyer McKay representing Wyoming Realtors and Wyoming Horse Racing LLC. And we hate this bill and we think it should go away. The bottom line is that a gross receipts tax is hugely unfair to the sole proprietors in this world. This bill would only capture those funds or the gross receipts from people that have to file. So it'd be the LLCs, the LLPs, and the corporations. A lot of our members operate as sole proprietors. So you're not going to get any of their information anyway. And so you're not going to have an accurate picture of what's really out there. Plus, Texas did this exact same thing. They had a bill to study it, to report the gross receipts, and the next year there was a bill to impose a gross receipts tax. So we think a gross receipts tax is absolutely one of the worst ways the state can go. It negatively impacts startup companies. It is, in my opinion, an income tax on self-employed. So we're opposed to the bill. We're opposed to gross sales tax, gross receipts tax. And I'd be happy to answer questions.
I really wish you'd be more clear about these issues. Questions for Ms. Overcut? Questions? Thank you.
Thank you.
Thank you. Who's next? You may not have to all pile on. Anybody else? Anybody else? Committee, you've heard the testimony. What's your pleasure?
Mr. Chair,
Mr. Co-Chair.
I'll move the table the bill and move on.
Okay, table indefinitely.
Does that mean for no further discussion, Mr. Chairman?
It would have to be brought off the table at some future date if you wanted to. That'd take a positive motion. As opposed to tabling to a date certain where it would kind of pop up on its own. So this tabling basically kills it unless somebody gets enough votes to bring it back. Question. Precedental motion, so I will have a question. All those in favor signify by saying aye.
Aye.
Opposed, no.
No.
Duly noted. So the bill is tabled. The next bill for our consideration is, I'm trying to remember what's next. It's something,
We're gonna do minutes.
oh, we're gonna do minutes. So can we do minutes real quick? Everybody? So let's have a motion on the minutes, and then Senator Bikeman had a correction, I believe maybe others have to. So we have a motion to approve the minutes. Motion. Got one for somebody. Might have been the cameraman. That's second by Dave, Representative Biden, or Senator Biden.
Yes, sir. Page 5, middle of the page, I would need to make a correction within the parentheses of income tax, add the word corporate in front of it. Where it says Senator Biden moves to remove House Bill 220, add corporate and funded income tax.
So, you know, some constituent of yours is gonna report that you left the door open to support a corporate tax on individuals, or an income tax on individuals. You know that's what's gonna happen.
I'll take the blowback.
Fair enough. Further discussion? All those in favor say aye.
Aye.
Opposed, no. Any other corrections to the minutes? Any others? All those in favor of the minutes say aye.
Aye.
Opposed, no. Thank you. The minutes stand approved as read. The next bill ought to be quick and easy. It's 20 LSO 82, National Retail Fairness Act. And I believe we will start with Representative Obermueller on this. He should have a lot of dry powder because he did some good work on the last bill. We'll get it passed out to the committee. We'll set the extras back there.
And a copy for the back.
Need a couple extra. Thank you. Okay. Josh, we can keep some extras back there for folks that may want it. A couple extras. Okay. So this is, we're not looking at something from Representative Obermueller. We'll turn it over to you, sir.
Thank you, Mr. Chairman.
You got to speak up because they've been complaining in the back. We don't have a microphone due to the fact that all the microphones are tied up with the Capitol celebration, I guess, is the way I understand it. Anyway, go ahead.
Is this picking up my voice? Is that what this is about?
We are being broadcast on the internet, and it uses that remote mic there and these mics here, is my understanding. But it's not picking up comments from farther away.
I apologize for my soft voice in advance, Mr. Chairman.
Okay,
Try to talk up.
thank you.
Mr. Chairman, members of the committee, good to see you all. I'm bringing this bill again in a revised form after listening to the testimony during the past session. We all know and appreciate the good words, liberty and freedom, independence and self-reliance, patriotism, and the values of our rural heritage. We understand defending ourselves and our way of life militarily. There is less understanding, however, on how to defend ourselves economically. The global markets have taken hold in Wyoming. Global markets follow profits. Its master is the shareholders. It is not a friend-to-friend relationship like hometown businesses. Hometown businesses, in fact, are swept away by the global markets, as one of the mayors mentioned earlier. Its presence is felt in every major economic sector in our state. Trade deficit relationships follow profits, meaning cash leaves the state every night by automatic electronic fund transfer. Our capital is being drained one day at a time. On my trip down here today, I was listening to the radio and heard that Ross Perot had died at the age of 89.
Wow.
And
And his ears died 2 days later.
that's really brutal. When I heard that, I was reminded of his famous saying, that sucking sound is our jobs going to Mexico, right? And that's what we have here. That sucking sound you hear is our capital leaving our state of Wyoming in the global markets, the global economy, which has taken hold of our state. If this weren't enough, then come the demands on our state government. free education for their employees' families, access to safety net programs for their employees, availability of critical health services, new and longer streets to accommodate their presence, more police and fire protection, a great highway system, and in today's modern society, livable cities full of attractive amenities. This is the cost of receiving products, services, and jobs from the global marketplace. A grand bargain that leaves the state holding the empty bag. And while we go about like old times, pronouncing cuts first, then revenue, the global marketplace responds by saying, no, no, no. We're not going to let you continue to do that. The global markets still want their money. They hold to their demands for up-to-date conditions in our schools, health facilities, safety net programs, roads, police and fire protection, and amenities. Our options as a state are limited to how we defend ourselves economically, and by extension, our liberties and freedom. We can only demonstrate our independence and sovereignty as a state by application of tax policies and regulation. Our ability to tax and regulate is our only refuge and defense. If we legislators can't buck up and handle the global economy, what good are we to the folks that we represent? This brings me to the fundamental question here. In spite of everything I've said, the question still remains, do global markets that come to Wyoming have any obligation to the public burden? You will answer that question when you vote on this bill. I'll repeat that question. Do global markets that come to Wyoming have any obligation to the public burden? If you vote no, please tell us who should pay for the state services the global markets demand. Wyoming is the last holdout in the United States and possibly the civilized world for laissez-faire economic policies toward big business. With our one huge exception, of course, energy producers. They have carried the tax burden for 50 years. They can no longer be counted on to do that, and frankly, they shouldn't carry the entire burden anymore. In my opinion, we're better off with one or two big tax ideas rather than several small ideas, which have been shown as easy pickings for the known new tax, no matter how small contingent. When we can't pass a $25 a year increase in a 20-year-old fee, we might as well go for the big one, and this is it.
I love this.
The National Corporation Tax Recapture Act. We named it because this act, taken from the testimony the last time that was too narrow, broadens this tax on corporations of more than 100 shareholders that was limited to retail last time. It now is all corporations with more than 100 shareholders. In testimony today, others will try to take you down the rabbit holes surrounding this bill. Is this bill perfect? No way. As a state, we're subject to national equal protection and Commerce Clause rules. Perfect protectionism is unconstitutional. But I'm reminded of what Senator Enzi said about the 80-20 rule of legislation. So if I've gotten this 80% right in terms of helping small business in the state of Wyoming and giving small business just a tiny edge, and that's a reasonable outcome, and that's good tax policy. So with that, Mr. Chairman, I would like to go over the significant pieces of this legislation. The happy news is that it's a very short piece of legislation in terms of its content. Most of it is boilerplate information. So there's just a few things that are unique to Wyoming. And I have a handout for everybody to look at the bill on one page.
Who's that? Representative Blackburn.
Representing Obermueller, I got these two copies here, so I had this one prior to and made lots of notes in it. Is the new one that you just gave us, is it identical word for word? Or do I need to,
Mr. Chairman, it is
Representative
not,
Obermueller.
I do not know what's in the material, so.
I think it's the old bill.
no, it's LSO 82.
Yeah, so it's a new draft, but it's pretty much how the engrossed version of last year's bill is what it's.
So it'd be the bill as it left the house.
Okay. So what I'm presenting today then is an alternative to that bill, and I will tell you where those changes are.
So this way we can learn about both bills, so we'll find out.
Apparently, Mr. Chairman.
Yeah. Well, it's important. Go ahead, Representative Obermueller.
Okay, thank you, Mr. Chairman. So, like the previous bill, the rate of tax is 7%. All the dates are pushed back so that if you look at the spreadsheet that was just handed out to you, I will show you how this is laid out. The first part on the left-hand side are all the section numbers. The second column, or the third, and then the statute numbers are to the side of that. Excuse me. Then the description of what those sections are about. Then I have a page number and a line number. And then all other pages are conforming language to multi-state tax compact model bill. So all the blanks there are have to do with language that's taken from the multi-state compact. The multi-state compact is a model bill that states can adopt, not adopt. They can do what they want. It's a place to start. That's where we started with this bill, is the one that comes out of the multi-state compact, which is comes out of a group of states that have a voluntary association that works on state tax issues. So that's where this comes from. Like the previous bill, the rate is 7%. All the dates on page number 12, line 19, the first payment is pushed back to 22. Then it's all boilerplate enforcement mechanisms that conform with other statutes that Wyoming has. Page 18, line 20 are the credits against the tax, and those are the same as the old bill. Now, in relation to the old bill, when I went through and updated this, thinking that this was going to be in the materials the way I have it now, you may be off one page in making these comparisons, because I did have to make some adjustments in the page lines and line numbers because of the changes that I made. So the credits against the tax: excise, sales, use tax, severance tax, and ad valorem tax. The credits for severance tax is designed to take the energy producers out of this. So even though that they would be subject to this tax, they will, by being able to deduct sales tax, use tax, and severance taxes, the energy producers will be taken out of paying this tax, which was one of the goals.
Mr. Chairman.
Representative Sweeney.
Mr. Chairman, the credits actually started on page 20 in the version that was handed out, line 19 in our version, Representative Obermueller.
Thank you, Rick, that's correct. You didn't get that change made. Page number 20. And line 15, thank you.
19, I believe, Representative Obermueller.
Right, yeah, exactly. Yeah, it's under the sections, line 15 credits, the following shall apply. So line 19, that's right. So that was part of the original bill. I have added a provision in this section, and that is 20, make sure it's the right one. Starting on line 21, it has to do with property taxes.
Which page are you on, Representative?
On the new bill, I'm on page 20,
Okay.
continuing on the credits.
Changes that get sent.
Oh,
So
I see.
the line numbers might be.
Okay, so I need to catch up to,
I see a reference to property taxes on page 21,
yes,
lines 2 through 4.
okay. So the version you're looking at is even newer than the version that I was looking at. So
Okay.
here we are. So we just have to.
We do have adaptable minds.
Generally.
Go on.
Okay, so the line says, no credit shall be allowed for any tax collected or remitted by the taxpayer on behalf of another person, including property taxes paid by the taxpayer on property that is not owned by the taxpayer.
So what you're trying to accomplish there is to, if you lease a building, you can't claim the property tax on that building.
Okay, that is correct. Because what happens is you create this unintended consequence of having these big corporations buy real estate in Wyoming and other entities, and then take the credit if there's any nexus at all to their business at all. Then in the main business, the main corporation, taking that as a credit by paying the taxes for those entities. That is an unintended consequence. The property, in my own writing of this bill, I'm trying to not allow that credit at all. If you go back to the original intent of these credits for sales and property tax, the original intent was to protect the little guy. So the credit in that in the original idea of back in 1974 was, we will give you a credit for sales and property tax. The idea is to protect the little guy in the state in case we ever have an income tax. And now here we are in 2019, and this credit for property tax all of a sudden being used by the biggest potential taxpayers in the state. And it's an unintended consequence. So by limiting the property tax deduction to the entity itself, we effectively eliminate the property tax as a valuable tool unless they choose to contribute those assets to the corporation to get the credit, which puts them in a decision model of, do we really want to do this? Because you don't put appreciating property in corporations. And the reason you don't do that is because they appreciate in value, and it's a double taxation situation. So you sell the property, it gets taxed in the corporation, but it does not increase the basis of the stock. So when you take it out of the corporation, it's taxed again. So that's why corporations do not normally put appreciated assets into corporations. That's why they have the separate entities that do the lease. Got it?
Got it.
So my intent is to basically eliminate the use of the property tax in this environment. It was never intended for this kind of situation. Again, it was written to protect the little guy. There was an interview that was done with Nell Smith, and that interview was posted out in Better Wyoming. They interviewed him a while back in the last few years about this very item. And that's what he said. The intent of this was to protect the little guy in case we ever have a net income tax. So it's clear what the intent was. And so I do not want that applying here. This is my effort to do that.
Okay.
So reading on down. All right, so we get to the next important piece is the distribution section, 3912-111. Josh, what page?
22.
Oh, yeah, right at the bottom page. All right, so I have left this language the way it was in the original bill, which is that the money goes to the school foundation program. The next uniquely Wyoming feature is the 100 shareholder provision. And all of that starts Josh, help me out again.
I think it's page 24, line 13,
Thank you.
or it's just in the definition of taxpayer there.
Right. Taxpayer means any person who has taxable income earned in Wyoming and who files or is required to file federal Form 1120 with the Internal Revenue Service if the corporation or the affiliate group has more than 100 shareholders. So in this section, I dropped all references to NICS codes, making it apply to all corporations with more than 100. Then there's a section on the handling of unincorporated entities. That starts at line 16 on page 24. Taxpayer shall not include any person who makes an election as an unincorporated entity and shall not include a limited liability company that makes an election to file taxes on federal Form 1120 to the Internal Revenue Service, regardless of the number of members of the limited liability company. In those situations where we have limited liability companies in the state with a lot of members, they will file 1120 out of convenience, just so you don't have hundreds of K1s going out. So it's an election of convenience in most cases. I don't want to capture that group in this. The target are those corporations that trade on the stock exchange, and that type of entity. So I don't want an unintended consequence on picking up that kind of entity. Okay. Josh, there's also one related to, yeah, I see it. Go back to, on page 24, line 13. The one is just before what we just talked about. For purposes of this paragraph, an employee stock ownership plan shall count as one shareholder regardless of the number of employees in the plan. This came up, this is a pretty good catch. We don't want to catch a company that has a stock ownership plan and then have every employee count. So that whole employee program is one shareholder for purposes of these rules. And then the effective date is January 1, 2021. Mr. Chairman, I'm open for questions.
Thank you, Representative Obermueller. I can see you put some time in it. Members of the committee. So just by way of telegraphing here, obviously for the public, you haven't seen this bill before. We haven't seen this bill before. So I think the best we could do on this bill today would be to move it forward and get it in LSO form, get it properly circulated so all the public has a chance. The other bill, of course, if we decide to take it up, it has been properly noticed and we could decide to do that. I suspect that's not going to happen. But so I'm just telegraphing to you that this isn't the desperate last all or nothing, and we're not going to shortchange the process, okay? So we're just seeing this for the first time. Representative Senator Ellis, I'm sorry.
Thank you, Mr. Chairman. Is it fair to recap? I tried to track them side by side, and I think there were 3 pages where there were changes. And it was, one was, I think, a fairly minor change on who has jurisdiction. On page 5 of the new working draft that Representative Obermueller provided, it's at subsection F. He added the language, the district court of the county in which violations of this subsection occur shall have jurisdiction over those violations. Then starts with no person shall. That's similar to the bill that was already introduced.
Right.
And then you talked about the new language on his draft, page 21, including property taxes paid by the taxpayer and the property owed. And then the final was the definition of taxpayer. Is that it? Were those the 3 big changes you made, or did I miss something else?
The dropping of the NICS codes, if you cut that.
That's in the definition of the
Right,
taxpayer.
yeah.
So
Okay.
That's it.
But that's a gigantic change as far as the
It is,
public's
yeah.
concerned, because that takes a bill that was a big box bill and turns it into a general corporate tax bill. So, I mean, I view that as really substantial.
Yeah, that is.
Okay. Questions for Representative Obermueller? Representative Blackburn?
Mr. Chairman, thank you, sir. Representative Obermueller, I'm just wondering, why did we pick schools to put all this money in?
Representative
What was the
Obermueller.
thoughts there?
Go ahead.
Mr. Chairman, the thought is that according to the final goldenrod that was published in March, the school foundation program deficit was $371 million. We have, overall, that document showed $479 million, so there's room in other places for money to go, obviously. But I just picked the biggest target. So, I mean, this is a piece of that, you know, that has room for discussion, frankly. But I left it the way it was in the original bill.
Anybody else? Representative Cotton?
Thank you, Mr. Chairman. Representative Obermueller, as you can imagine, we received enormous number of email messages about kind of the version that we thought we'd be looking at today. And a lot of that we talked about kind of throwbacks and clawbacks. Your new version, that's totally irrelevant at this point. Is that correct?
Representative Obermueller?
The throwback rules that's a related issue, but it's not directly related to Wyoming defending itself in the national retail global market environment. It's a curiosity rabbit hole that we can go down because throwback rules apply differently to every state. Some have them, some don't. Every state defines those rules. So as you look at the throwback rules, and Mr. Chairman, with your permission,
Of
to
course.
better answer that question, I'll have you just briefly look at this one sheeter, if I could have that
Okay.
passed out.
But
I don't want to take a lot of time with this, but there are just a couple of these lines that I want to point out.
Okay, Representative Obermueller, hang tight. Would it be, let me just ask this, is it fair to say that there's no more or less throwback issue in this bill versus the previous bill because the number of the types of corporations changed? That throwback is not a function of being a big box store or a retail chain. It's a throwback of having a corporate headquarters somewhere else in tax jurisdictions across, so it's no more or less. I think Representative Obermueller's been thinking about it a lot more, and we'll shift to him. I hope I didn't misspeak, but
Mr. Chairman, that's
more for the public, Dean, if we could.
okay. And
Share, please share.
okay. If you look at the history of the multi-state tax apportionment, these are all the voluntary organizations, or the voluntary groups of states that over the years have come together to work through issues involving state taxation. So if you look at 1957 was when the 3 factors formula, payroll, property, and sales, was introduced into this uniform tax program. It's coming out of this voluntary group. And that's what this bill does. It's related to these 3 these factors related to this history here. I just wanted you to walk down, you can see the history of this, but you walk down to 1967, or 1965, 67. It says, states rallied to protect their sovereignty over tax base, and many enacted the UBIT formula directly into their statutes. Well, that's that three-factor formula again. The important words there are states rallied to protect their sovereignty over tax bases and their own definitions of terms. We're dealing with 50 different states. And so this came up as an issue because it came up as an issue of kind of convenience. Well, if our income is taxed in another state, then we might as well tax it and it's a wash. That's what the argument was at the time. So the reason it's a rabbit hole is every state has its own definitions of these things and interpretations of the model language of which has that language on throwback rules in it. The model language has that language. That has not changed in this bill. But each state figures that out for themselves as to what that language means. And then it runs through its normal process. A taxpayer files it a certain way and they get sued by the Department of Revenue in the state and it goes to court. It can work the other way too. So you know that drill. These are state-related issues. And so anybody who comes forward and says, well, this is the definition of these things, that depends. It depends on what, one more handout, please.
You have been busy, Representative Obermueller. You have been busy.
You should have started.
I didn't know that Representative Conley was going to tee this one up for me, so it was sitting in the stack.
Do you have a
But I
copy
do
for
need,
yourself?
I need to get one back.
Dean, one for the presenter.
I think I almost have it memorized by now, but.
Thank you, Dean. I think you've done a very good job of passing those out.
So.
Extra for the folks if we can. Okay.
All right, this is the Department of Revenue in the state of Arkansas.
I think we've seen this one before, actually.
We have, in another context, in corporations, when it's presenting this bill.
Yep.
So they were looking at the throwback rules and how much money was generated through the throwback rules in Arkansas. And so this is addressed to the Honorable Jim Hendren. This is a tax reform and relief legislation tax task force looking at the different things involving their state taxes. And one of them was the throwback rules. So in an effort to explain it to the legislature, they turned to page 2, they wrote this. The throwback rule is part of the calculation used by Arkansas concerning the apportionment of business income by multi-state businesses for income tax purposes. Arkansas uses an apportionment formula consisting of payroll, for property payroll and sales factors to apportion income of a multi-state business as shown in the tables describing the single sales factor apportionment. The throwback rule is part of Arkansas law that determines what are considered Arkansas sales for the Arkansas sales percentage in determining apportionment. Under existing law, a multi-state business is required to include unreported out-of-state sales in a sales factor under that section. And that section happens to be the model language from out of the multi-state commission, the multi-state tax compact. Stated differently, so they're taking another stab at it here. Stated differently, all sales must be reported somewhere. Otherwise, the taxpayer will have untaxed nowhere income. So this causes a little bit of dilemma in Arkansas as to who should be reporting this. We can solve that problem by passing this bill, and it will be forever resolved. From Wyoming's standpoint, it makes no difference. It's a curiosity how this plays through other states, whether they collect it or not. There's a state-by-state analysis. But it doesn't make any difference in us doing what we need to do to protect ourselves in the economic environment. So I consider this an ancillary issue of curiosity, but not of importance in terms of passing this bill.
Okay. And there still is an element, Representative Obermueller, of the fact that if we can grab this income and they're reporting it properly in Arkansas, picking on one particular company perhaps, then it's just a shift of tax from Arkansas to Wyoming in part, depending on the rates and depending on everything. But you're saying it's really kind of a red herring and it's not worth spending a lot of time on.
Mr. Chairman, we're
Yes.
dragging ourselves into state situations and injecting ourselves into their environment where these companies are trying to say, oh, we don't think we owe tax on this, and the state sends this out, and that clearly has a message. So how does this stuff get sorted out? Like it always does, in court. No, none of us has this definition, and you can't rely on one state to define it for another, or an organization to define what these terms mean. It's a matter of legal interpretation. And if you look back at the first sheet that I gave you and look down toward the bottom, and you'll see California just recently, their Supreme Court got involved in some of these issues involving apportionment issues. So all this stuff is resolved in state courts. That's why I don't like this bill getting dragged down that rabbit hole, to take away from the emphasis that we need to do our own thing. 48 other states have dealt with this issue. South Dakota has dealt with it in specific instances with banks and with construction companies. We're the only ones that haven't stepped up to deal with this issue, and that's what I want to focus on. And not be sidetracked by these ancillary issues. Personally, I don't care whether they pay tax on it in another state or not. I want our money. That's what I want. I want our money. If that means it's more tax to them, that's fine. Would it be nice for them if it's a net transaction? Great. But I want our money. So any objection that's brought up, it comes back to that.
Anybody?
Mr. Chair.
Who was that? Senator Biden.
It's not our money, it's business's money.
Thank you.
And we are taking their money. So when you say our money, I would kind of push back on that a little bit. Taxation is taking someone else's money.
Mr. Chairman.
The money. So
Mr. Chairman.
Okay, so I'll take a deep breath right now. This will be a good time. Take a deep breath. Point well made, Representative Obermueller. Take a deep breath.
Mr. Chairman, that is a good question.
Yep.
That gets back to the tax money that these companies are extracting from our businesses, or our people in Wyoming. It gets back to the fact that my relative in Seattle and my relative in New Jersey pay the same price for TV as we do here. So what do you think is going on with that?
Talk to the chair.
What do you think is going on with that, Mr. Chairman?
Thank you. Gee, I don't know, Representative Obermueller, but it's a good point.
Well, I'll tell you, Mr. Chairman, what I think it is.
Okay.
I think it's a distribution of all costs back to every customer. The distribution of all costs back to every customer. All of their taxes, everything else goes into a bucket and it gets spread by uniform pricing across the nation. So just because it's hidden in a product cost doesn't mean it's not a tax. And so those taxes that are hidden in products in a state that doesn't even tax those entities, I want that money back. That's our money. That's our people's money. That's what we're doing on behalf of our customers, is getting their money back.
Thank you, Representative Obermueller. Mr. Co-Chairman.
So, thanks, Mr. Chairman. So now that we have, in exploring this bill without NAICS codes on those two industries or three industries we had previously, and you're going across the board, I mean, we're affecting a lot more corporations that, let's say regional, let's say just 2 states, et cetera. I mean, that same argument applies, this whole, I understand the national retail pricing model with the NAICS codes we used to have, but we're opening up to real estate, to hospitals, to transportation companies. Does that same argument that you just utilized, I mean, apply when you have just, let's say, a 2-state, Wyoming and Colorado corporation? I don't know if we even have any other 100 shareholders that are large enough to be 100 shareholders, and small enough to be a regional or 1 or 2 state entity. Would it operates the same way?
Representative Obermueller?
A company like that, if they're privately held, has a few more options to deal with this. You know, in the accounting profession, you deal with how you structure yourself, Mr. Chairman, for the best tax outcome. Right? I mean, that's part of what planning is. In today's environment, for example, a C corporation, its top rate is 21%. Mr. Chairman, if you have a business personally that makes as much money as that C corporation did, same net income, your top rate is 37%. It's the biggest spread I've ever seen since I went into the accounting business over 40 years ago. Huge spread. You know, that creates this competitive balance issue.
Mm-hmm.
So what do companies do that are smaller? You know, they look at this each year and they figure out how to navigate the tax system. Are there companies that would get caught up in this? Yeah, that's why I referred to the 80-20 rule. I mean, I'd like to just make it perfect, but I can't do what President Trump is doing and say, okay, we're just going to work with selected tax regimens with tariffs and this type of thing. We have limitations because we are a state. So our only line of defense is a reasonable tax policy, and I'm trying to craft this to reach our goals to the maximum level, but can I guarantee you to eliminate every possible exception? No, sir.
Anybody else? Representative Conley?
Thank you, Mr. Chairman. Representative Obermueller, I just pulled up the fiscal note from 220 from last year, and it was $45 million per year, 90 for a biennium. I'm curious if you have any calculations about what the revenue would be from this bill without having just the specific NAICS codes in it.
Representative Obermueller?
Mr. Chairman, I would call on our Director of Revenue to see if he has any information on that.
Well, it's a little bit unfair because he hasn't even seen this bill till today, and it's a much broader application, but we will hear from him. Can we put that on the side? Fair to say that if you're going to catch more entities with this new bill.
That's fair to say, Mr. Chairman.
And so it ought to be bigger. Do you have a follow-up?
I do.
And we will get Representative Noble. I'm not going to let you drag him up yet like you did last time. Go ahead.
And so, Representative Obermueller, just curious if you thought about the rate of 7% in relationship to the expansion of the NAICS codes.
Representative.
Mr. Chairman, the 7% is still a rough estimate of the average corporate tax rate in the nation. So I'm just trying to set us in there somewhere as kind of an average collector of corporate tax.
Okay, but we have to add on to that. Nobody else has our dollar for dollar deduction for other taxes paid. So the effective tax would be lower depending on how much of those other taxes paid.
Mr. Chairman, that's correct.
Senator Ellis.
Thank you, Mr. Chairman. Just would appreciate some discussion about in revising the definition of taxpayer, why the 100 shareholder threshold remained intact. I know that was a sticking point for some folks, concerns about Commerce Clause and special laws under our own Constitution. I was wondering if we could have some discussion about why that was remained, or why that's still in there.
Back to you, Representative Obermueller.
Thank you, Mr. Chairman. In looking for a definition of what a small business is in relation to a large business, the federal tax code says that if you have 100 or less shareholders, that you are by definition a small business. the 100 shareholders is connected to the federal law in this regard. If you have 100 shareholders or less, you can file as an S corporation, and which looks similar in tax preparation to partnerships, LLCs, individuals. All the money flows through to a personal income tax return. When you cross the 100 threshold at 101, you must file your own return. That's why it works in Wyoming to do this, because in Wyoming, without a personal income tax, this works perfectly in that environment, because the target of this tax are corporations that otherwise must file their own returns with an 1120 as a C corporation under subchapter C rules. So it's a very distinct, identifiable group of taxpayers.
Does that help? And then you also, you just spoke about this, but it's also connected with the fact that these entities pay lower federal income tax than other entities. So it's sort of a balancer. Is that fair to say?
Mr. Chairman, if those corporations picked up 7% in Wyoming, that effective rate would be 28% that they're paying
Versus
37 plus 7, or 37 for the rest on the individual, not plus 7, 37. So there'd still be quite a gap even with this addition.
Thank you. Any other questions for Representative Obermueller? Any other at this time? Let's make room for Director Noble, because he loves this off the cuff stuff. Welcome, Director.
Thank you, Mr. Chairman.
Would you like to just, I'll just start to give you a chance to just off the top of your head.
Okay. Mr. Chairman, I did hear that this tax was going to be broadened to remove the NAICS code limitation. I was aware of that. I started looking for data anywhere I could find it that might help in trying to figure out how much income could be generated from a tax like this. I looked to the state of Nebraska because they're a neighbor and they have a fairly robust income tax. It starts out at 5.58% on the first $100,000 of Nebraska taxable income, and then moves to 7.81% above $100,000. Some kind of interesting data points that I noted in Nebraska. That income tax generates $258 million a year on C corporations. S corporations comprise 18 million. So the total corporate income tax in the state generates $276 million. Of the C corporations in the state, that report in the state, there are 20,810 of them. Those reporting income in excess of $5 million, and that represents 60% of the tax that is generated. There is 153 reporting entities that comprise that number.
153 did how much?
153 entities reported 60.58% of the total tax liability for the entire state. If you look to those reporting in excess of $1 million, you add another 216 entities, and they comprise 8.48% of the liability. Between 2 and 3 million, another 5.17%, and between 3 and 5 million, another 8.58%. So you're talking over 80% of the income is generated by those reporting more than $1 million in income in the state. my guess is you're probably looking at those C corps with more than 100 shareholders at least. And if nothing else, we can look to that as a number that we can somehow work with as a starting point for what we think this might generate. Then we have to look at what the impact of the tax credit might be. Now, if what I understand is correct, Representative Obermueller in his bill is adding two taxes that are not listed in our Constitution.
Right.
Excise taxes are not listed, and neither is the severance tax.
Correct.
Okay. They would still be deductible. The difference between a deduction and a credit. So under this bill, you're adding two items, two tax credits. And I guess my question is, when it comes to carrying forward losses and things like that, or going back with losses, are those things just going to be carried back in perpetuity? I'm just really curious as to how this will operate. Will it be like a normal corporate income tax where you have loss carry forwards and carrybacks? Or is it, if you don't have any taxable income, it's just zero that year and you move on to the next year? I don't know that at this point.
Let's get Representative Obermueller on that.
Mr. Chairman, the carry back, carry forward issues have not been addressed in this bill yet.
So be fair to say, as this bill stands right now, there is no carry. Would that be fair?
That's fair.
So it's each year's a new day.
The reason I ask that is because when you look at the state of Nebraska, on the C corps that report in the state of Nebraska, 7,183 entities out of a total of 20,810 C corps report no tax at all.
Right.
And that represents 34.52% of all the corporations in the state. Obviously, the tax is paid by the large corporations. And this is information that I just got a couple of days ago.
Mm-hmm.
The other thing that was interesting, and Nebraska did a really good job of this, is they provided a breakdown of the major categories of income and expenses or deductions. And the one that stuck out, or I should say two, under gross receipts, $131.546 billion in gross receipts.
Mm-hmm.
In taxes used as a deduction against that gross receipts, $4,271 million in taxes. Now remember, you have to take and add that 4.2 billion back into the 131 million.
Right. 135 billion.
Right. And then you would take it, that same $4.2 billion, depending on whether these taxes are actually included.
Right.
And you would take that and
Subtract.
apply that against the tax that was calculated at the bottom of that.
So if it was 7%, just
Yes.
roughly,
Yes.
what is that, gonna be like $8.5 million? And say that everything was deductible, subtract out 4.5, it cuts your take in half, roughly. Very rough numbers.
Yes. Yes.
And that's if everything were deductible in Nebraska and they did it our way.
Exactly. Mr. Chairman, the thing that I want to do is I want to spend more time. I actually want to go to the state of Nebraska and meet with these folks and talk to them about it. But I want a better picture of what this data is actually telling me. You folks deserve an answer at least as good as I can provide as it relates to what this tax should generate. And I just need to know what taxes are included in that one and how it would impact even their data. I want to make sure I'm right in what I'm assuming.
Did you talk to Nebraska about the cost of collecting that?
I have not. That will be another discussion with them. What system they use, how they approach this process. I'm going to try to steal all the forms that I possibly can from them to figure out, okay, how would it look for us to do this as well. But I think the thing that is probably more important to this exercise than anything is to figure out, number one, who would be thrown into this tax. And even if you make the assumption that it's just a really, really big tax payers, that's still an awful lot of tax being generated by those taxpayers. And granted, we're not Nebraska, it is not exactly the same environment, but I want to find out if there's any more information as it relates to those taxpayers themselves. And then I also need to figure out how this credit will actually impact it. And now that I know that it does include excise taxes and severance taxes, what that will look like. Then the issue becomes, how do we handle the carryback situations and the carry forwards?
So that's a good assumption, providing the committee approves us going down this route and doesn't change any of those things. But further questions for, we got Mr. Noble up here. Mr. Co-Chairman.
I think, Mr. Noble, Mr. Chairman, would I be correct that the fiscal note you provided on House Bill 220 would remain unchanged? The cost of the system to get this up and going, I mean, within,
Mr.
pretty
Noble.
close.
Okay, Mr. Chairman, what I would do, I actually did this after after our last session. I approached the people that wrote our software for excise and for our mineral tax system and asked them to give me an estimate, and it was less than that. I don't know the exact number, but I will get it. I will get you that number as well. The thing that worries me is they've not ever written an income tax before, so I want you to be aware of that. Now, will I continue looking? Yes. We're not going to try to take just a off-the-shelf price and run with it. We'll get you the best price we possibly can. But recognize this is not an uncomplicated tax. It does generate some issues. Not only would you have a fiscal note from me, but you probably have a fiscal note from the Department of Audit as well. And I'm not sure that was provided last year. But they would have to audit this as well.
Fair enough to say on the bottom line is that I think we talked about $20 million to administer last year. That may be on the, if you were to do that again, you'd probably provide a lower estimate for that particular bill. And we don't know what it would be for this bill. Is that fair enough?
Mr. Chairman, at this point, I don't know what it would be. I think it would be roughly the same as what I can do.
It's like the rough of the rough.
It's all gonna be rough, Mr. Chairman. I hate to say that, but it's an area. One of the reasons that I asked for an off-the-shelf solution was because it is an income tax that's been done over and over and over again. These folks are good at it. They also are very proud of it. I mean, the point is, we were asking for a solution and something that could be put in place fairly quickly. If someone has to write this from scratch, it's going to take a couple of years at least.
And just fair enough. And the estimate you're providing is the one-time upfront estimate.
Mr. Chairman, that's correct. There will be ongoing costs, obviously associated with people and materials, printing tax returns, all of the things that go into that system.
Further discussion from the committee? Questions? Let's let the public get involved in this. And Representative Obermueller, in case you have to answer questions, will you stay close? I will.
Mr. Chairman, thank you.
Thank you, Mr. Noble. Who would like to be the first from the public to talk to us about this bill? I know you're all excited. Yes, sir. Come on up. And I do see we have the tax foundations on the agenda. We'll get you after a little bit of public comment. We'll work you in, okay? Promise. Yes, sir.
Mr. Chairman, members of the committee, Joe Spearing with Wyoming Contractors Association. I'd like to thank the chairman for recognizing the substantial change that has been made to this bill. It is no longer the National Retail Fairness Act. The removal of the NAICS codes has swept in a lot of corporations and a lot of companies and a lot of industries throughout the state. Among those, I believe, will be affected are a number of construction companies, a number of our members, and that will essentially empower Wyoming to pick winners and losers within the construction industry that are bidding very competitively on public works contracts or even private contracts. So I would really urge the committee to reconsider the removal of the NAICS codes classifications and the resulting major change to this bill and potentially restore those classifications to narrow the scope of the bill and restore it to what it was initially intended to do.
Okay, thank you. Questions? Thank you very much. Who's
Thank you,
next?
Mr. Chairman.
Mr. Ralston, very good to see you.
Mr. Chairman. Mr. Chairman, members of the committee, Bobby Ralston, representing Wyoming taxpayers today. Like you, we haven't had a chance to run this by our board or our policy committee, so I'm not going to take a stance on it. I just want to say a couple things. One, it still appears to pick some winners and losers, and we would certainly have a problem supporting that within our cornerstones. It's a start. I mean, I will say it's a start, and I think it's important that this committee continues to look at this. There's still some questions in my mind as how LLCs of a large company like mine would be handled, and how those credits would work and stuff like that. But again, we'll have a better idea in September probably of a position, and I appreciate you taking this on.
Thank you, Mr. Ralston. Anybody else? Thank you. I bet you, in your other hat, you appreciate the deductibility of the severance tax.
I do.
Just thought you might. Yes, ma'am. Hello.
Good afternoon, Chair, members of the committee. Nikki Dove with the Council on State Taxation. We are a nonprofit member organization that represents approximately 550 large corporate members doing business all across the country and internationally.
And your name is Bobert?
Dove.
Dobe, I'm sorry.
COST mission is to promote equitable and non-discriminatory state and local taxes. So I was here last February to testify in opposition to House Bill 220. I've also resubmitted my comments with respect to that bill. Starting with that bill, we do believe that this is a very discriminatory corporate income tax. COST does not generally oppose corporate income taxes. We just want them to be fair and non-discriminatory. With the NAICS codes, that's a very obvious discriminatory feature. The removal of that, in our minds, still creates some discrimination. And I do appreciate Representative Obermueller's comments about the 100 shareholder designation coming from the federal tax code. That is something within the tax code, and I think he is looking for things to make this a better bill. So I do appreciate that. However, what that refers to is something called the S corporation election. So taxpayers that are under 100 shareholders can make an election to not be treated as a corporation, which will be subject to double taxation, meaning the corporation pays the tax and then the shareholder pays the tax when there's a distribution. They will be treated as a pass-through, so similar to a partnership or limited liability company. If that is the purpose of the representatives' change to eliminate the NAICS codes and just go to this 100 shareholder provision solely, I would encourage this committee to explore a different route and really look at those S corporation rules. If that's a way the committee would like to go, I think that's going to be a fairer bill. It's going to make it easier to administer. But including this 100 shareholder limitations and only applying this to corporation is going to create a fair amount of, in my mind, what you will see as gaming or tax planning. So I would really encourage the committee, if there is a fear that small business should not be subjected to this, that the committee look for a different way to go about that. So it may be a dollar threshold, it may be using the S corporation designation as a threshold, but this still creates discrimination. So we would very much encourage you to continue that conversation and keep working on that aspect. The other issue I will address is the throwback issue, and I'm only going to speak to it very briefly because Mr. Walczak from the Tax Foundation will be providing a presentation on that, and we've spoken and you will learn a lot. It's not necessarily an ancillary issue. States do have the ability to do this the way they would like to do it, but as this bill has been sold or in comments that I've received back on the comments that I've submitted, one of the comments I've heard is that this is going to be net tax neutral for the corporation subject to this, and that just is not the case. Based on the way the throwback rules work, again, the representative is very correct. They work in all different ways because the states, unfortunately, don't make their corporate income taxes uniform. We'd love that. They do not. So they work differently in all the states, and then each taxpayer's specific facts and circumstances are different, and that will impact how those work. So Mr. Walczak will get into that a bit more, but those rules, the bottom line is those rules do not create a tax neutral bill.
I think Representative Obermueller would agree with you 100%.
So that, and yes, so this is a new tax. This is a new tax, a fairly substantial tax on corporations. Again, I'm not here to oppose a general corporate income tax, but just have the understanding that this is a new and substantial tax on corporations. So I'm happy to answer any other questions, but we will take a look at the new bill when it comes out and submit additional comments.
Thank you, Ms. Dovey. Mr. Co-Chairman.
Thanks, Mr. I just want to make sure I understand your testimony when you say it's somewhat discriminatory. That wouldn't be between your members who make up cost or all the multinational corporations, most of which I would think are 100+ shareholder C corps. So I just want to make sure it's not discriminatory probably between your members.
Correct.
It's discriminatory because of the small business versus large corporations, and that's what's discriminatory?
Correct,
Ms.
Chair.
Dovey. Chairman, if you don't mind.
Chairman. Yes, that is correct. So the discrimination comes between a corporation with 99 shareholders versus a corporation with 100 shareholders. So you're drawing a line in the sand, and they're, under the Equal Protection Clause, treating different taxpayers differently. There is the potential constitutional challenge that would be found to be discriminatory.
Absolutely, Mr. Co-Chairman.
Is there a more fair, equitable limit? I mean, just apply it to every mom and pop as well, or S corps and C corps over 100, or if there's any recommendation, you'd have to make it less discriminatory. I'd be happy here.
Ms. Dovey.
Chairman, Co-Chair. I would suggest, and again, not having read the bill, looking at those S corporation rules, that is a policy decision for this committee to make. Again, when a taxpayer makes an S corporation designation, they are no longer being taxed as a corporation for federal purposes. They're being taxed on a pass-through basis. So the entity is not being taxed, only those shareholders. That is one avenue the committee could consider. Another avenue would have a dollar threshold that all corporations would be in. Certain corporations under that dollar threshold. There could be an argument made that also creates discrimination, but in my mind, that at least is taking away some of the tax planning opportunities that might be out there for certain taxpayers.
Thank you. Anybody else? Questions for Ms. Dovey? Thank you, Ms. Dovey. Who's next? Yes, sir.
Good afternoon, Mr. Chair, members of the committee.
Can you tell me, Chairman, please?
Mr. Chairman,
Thank you.
members of the committee. My name is Alex Klein. I'm the Vice President and General Manager of Grand Teton Lodge Company, Flag Ranch Company. There's been some talk of potential winners and losers. I guess that makes me a potential loser in this case. I've been fairly involved here in the state in Wyoming Restaurant and Lodging Association. I was the past chair of the Jackson Hole Travel and Tourism Board. A little bit about our company. Grand Teton Lodge Company was incorporated in 1936 by the Rockefellers. It was formed to take over some transportation, some small lodging operations. Eventually, in 1955, we built Jackson Lake Lodge, Coulter Bay Village, and grew to what we are today. During peak employment, we have more than 1,000 employees. In 1965, we added Jackson Hole Golf and Tennis Club just outside the park. And Vail Resorts acquired Grand Teton Lodge Company, which comprises our in-park operations and Jackson Hole Golf and Tennis in 1999. So we're celebrating about 20 years being owned by Vail Resorts. Coincidentally, in 1999, Vail Resorts also became a publicly held entity, far more than either shareholders based in Bridgeville, Colorado. Flag Ranch Company was formed in Vail Resorts to operate the newly acquired concession contract in the John D. Rockefeller Parkway, adding about another 100 employees. And Vail Resorts is still a publicly traded company on the New York Stock Exchange. This bill would have significant impacts to our company. It would be an incremental tax. We do not pay these taxes in the state of Colorado or anywhere else. So this would be absolutely a new tax to us. And I think when it comes to the unfairness and the unequal treatment, in our concession industry, we not only compete for room nights and customers, we also compete for the contracts themselves. In most cases, these contracts are held by wealthy individuals. We're actually one of the anomalies in the concessions world, where we're actually a publicly traded company. Most of the other players in this business are generally billionaires. Billionaires from Arizona, billionaires from Colorado, billionaires from New York. This puts us at a significant unfair advantage, competing for our own contract, which is expiring in about 2.5 years. I shared this testimony in February, and I think it resonated, but it's just one example, I think, of many. We heard about the contractors and the unfair treatment between a publicly traded company and another. I would urge you to examine this bill to really understand the impacts, to understand the unfair playing field. And while I think taxes are very, very complicated, I've learned a lot in the last 6 months in working on this bill, working with people far smarter than me. I was raised by a CPA, but that doesn't mean that I understand taxes in any way, shape, or form. But it's not as simple as corporations are paying 21% and individuals are paying 37%. That ignores the double taxation that exists when shareholders extract those profits from corporations. And while I know it's never going to be fair, a 7% tax is pretty significant. It's enough for us to end up paying hundreds of thousands of dollars more on an annualized basis. And in the competitive environment in which we play, it could be the difference between us winning a contract and losing a contract, which is far more than a few hundred thousand. Mr. Chair, members of the committee, thank you for listening to me. I'll take any questions you have.
Questions for the gentleman? I might ask, do you actually own your properties?
Mr. Chairman, Vail Resorts owns Jackson Hole Golf and Tennis Club outright. Inside the national park, we don't own anything specific other than what's referred to as leasehold surrender interest. We do pay property taxes on the personal property that we own, as well as the property that we pay, or the property that we own at Jackson Hole Golf and Tennis Club. We do, however, pay a large franchise fee to the National Park Service. Not necessarily a tax, but it is a significant dollar amount.
Mr. Chairman.
Go ahead, Representative Sweeney.
Thank you, Mr. Chairman. And I guess this question would be more for Representative Obermueller, but would that concessionaires fees be considered a tax on when they're filing corporate returns? And probably, I'm thinking it would be a deduction, as well as personal property tax.
Representative Obermueller, or sorry, Sweeney. I don't think it'd be a tax that would come off the tax obligation at the end, dollar for dollar. It would be an expense that could be deducted from the total profitability. And you could amend the bill to say, to allow for those kind of franchises paid to the federal government entities or other government entities, treat it like a tax. You could do that, but that might help them out. But right now, it would not be that. Right? Is that okay, Mr. Representative Obermueller? Did I say it right? Okay. Anybody else? Thank you very much for your testimony. This is just, we'll be around for a while.
Thank you, Mr. Chair.
All right, thank you. Mr. Brown.
Thank you, Mr. Chairman, members of the committee. Chris Brown, representing the Wyoming Lodging and Restaurant Association and the Wyoming Retail Association. We certainly appreciate the work that Representative Obermueller has put into trying to make this a better bill. The last couple of times we've testified about this, I've complained about the unfair nature of attacking just the retail and hospitality industry. So we appreciate the initial steps in broadening the bill. Unfortunately, the 100 shareholder piece, as has already been mentioned, still picks winners and losers. And I think it's important to understand that we're not talking about it picks David versus Goliath. We're talking about if you're shopping here in town, King Soopers will pay this tax and Albertsons and Safeway will not. If we're going out to eat, McDonald's will pay this tax, Chick-fil-A will not. Home Depot, if you're going for home goods, Home Depot will pay the tax, Menards will not. And so it's that unfair disparity of like businesses selling similar products to the same and competing for the same customers that gives us the biggest concern. As has been demonstrated for the past 3 years, I hope that the industries that I represent are not part of the no tax at any cost discussion. I've mentioned many times our proactive approach to trying to solve the same challenges, fiscal challenges that the state is trying to solve and that you all have been trying to solve for the past handful of years. We're appreciative of being able to be a part of that conversation. But this bill doesn't quite get there yet. If this bill was a fairly applied corporate income tax amongst all corporations proportionately, I think that might change our approach, quite frankly, Mr. Chairman. But as it is written in this new form, and granted, I haven't gone through the entire bill like no one has, we still remain in opposition to this bill, Mr. Chairman, and I'd be happy to take some questions.
Thank you, Mr. Brown. Mr. Co-Chairman.
Thanks, Chairman. I think what's being lost, and I'm not picking on you necessarily, but there are some benefits to being a C Corp with 100 shareholders, and businesses made that decision because there is a benefit to do so. And I would assume they weighed their options in every state and what that would be on a tax liability when they elected to go to, be a publicly traded corporation or whatever they are. And so I just have difficulty with this argument about, we're treating exact same similar situated entities differently, and that's discriminatory when there are some benefits for those corporations who are C corporations with 100 shareholders. They've done that for beneficial purposes. So would you agree with that, I guess, is my...
Mr.
Would you
Co-Chairman.
agree with that, Mr. Co-Chairman?
Mr. Co-Chairman, though, I think the point is that if you have thousands of shareholders, you can't make that election. And these publicly traded companies have thousands of shareholders. Granted, they have access to capital markets. There are a lot of benefits to having all those shareholders and organizing that way. But it's not like they can choose to be less than 100 or not. But your point is well taken. At the margin, a medium-sized corporation could choose one way or the other, I suppose, and it has benefits to doing it. Mr. Brown, you're certainly welcome to address if you wish.
Mr. Chairman, I don't claim to be a tax expert with every single nuance like that, but I will say, as I said last meeting, that I haven't had any members come up and say, hey, that levels things out and we're cool with this bill. I would certainly much prefer to get to neutral for us on this bill because, and frankly, the associations that I represent would like to also. We understand the state is facing a fiscal challenge and a problem. We want to be part of the solution. We're not there yet.
Thank you. Anybody else for Mr. Brown? Mr. Brown, I find it fascinating. Several people have said we could support this bill if it was a general corporate income tax. I mean, honestly, write that down. I heard several people say that. So it's like, as the bill gets closer to being a general corporate income tax, more people are supporting it. Maybe we should eliminate the 100 shareholder thing entirely. Mr. Brown.
Mr. Chairman, I tried to be very careful with my words in that sense that I am not saying we would stand and support the bill. I'm saying that I'm trying to get us to neutral in the name of we need to do something as a state to close the fiscal gap that we're facing. And I think that if it's fairly applied, pardon me, Mr. Chairman, I think that if the bill is fairly applied across all corporations, and as I said, proportionately, I think that gets us to a tougher place to fight against it because we do need to do something.
Yeah, you're also correct in the revenue situation, although it looked brighter for a while earlier this spring, really is pretty gloomy, more gloomy perhaps than when we left the session. So, thank you for your testimony.
Thank you, Mr. Chairman.
Representative Hallinan.
Thank you, Mr. Chairman.
Go ahead.
There are cases where billionaires own these kind of properties that you represent that would be in competition with these stockholder-held companies?
Mr. Chairman, Representative, yes. The previous speaker that just spoke, speaking about Grand Teton Lodge Company, that contract comes up in 2.5 years. If this bill was to pass, they would be subject to this tax. Xanterra, that runs Yellowstone National Park lodges, is owned privately by a billionaire. They would not be subject to this tax. So again, I love both of those corporations, but it wouldn't be fair for one to compete for that contract at ballpark between 5 and 7, 6, whatever the percentage is based on the constitutional credits. It still would, the constitutional credits don't eliminate the disparity between those two companies competing for the same contract. So yes, Representative, that is one example.
Anybody else? Thank you.
Thank you, Mr. Chairman.
Who else? Yes, ma'am. Welcome back. Couldn't stay away, could you?
No, you guys are too exciting.
Welcome. You have to reintroduce yourself.
No worries. My name is Lindsay Hanlon. Thank you, Mr. Chairman, co-chairman, and members of the committee. I remain a constituent of Cheyenne, and I'm here to support the passage of this act in whatever form the committee decides that it will land on. I attended school here in Cheyenne from kindergarten through the 12th grade. My mother was a special education teacher here during that time. I spent many afternoons in her classroom, helping her get ready, helping her with the students, and basically just seeing the passion that she had for her students. I went on to the University of Wyoming, where I double majored, and I was also a member of the honors program. I went on to Boston College for graduate school, and I'm very proud to say that I think that the education I got in Wyoming is on par or exceeded the education that my classmates who went to East Coast prep schools and had Yale undergrad got when I was at Boston College. I am less proud to say that I don't know if the current crop of Wyoming students is going to be able to say this when they are my age. The education budget has really been cut until it hurts, and then I think it's been cut some more. Class sizes have expanded, teachers, including my mother, have left the state, University of Wyoming programs have been cut entirely or combined, all in the name of saving money. Everyone has been told to do more with less, and the children in the state are suffering for it. I think that we all are aware that we need to be looking into alternative tax sources, such as this act, so that we can grow this budget instead of shrinking it. There are only so many cuts you can make to something before it bleeds to death. And I think that our education is going to approach that point. By favoring austerity measures over additional forms of taxation, we are telling our children that we don't care if our teachers are overworked and underpaid, as long as we can maintain the status quo. We are telling our children that their futures matter less than the pockets of corporations, and we are telling them that we would rather let their education suffer than change our ways. Thank you all very much for your time.
Thank you very much. Questions? Thank you. Ms. Johnson,
I'll just say what she said.
you could just do that, turn it right around.
No, I have more.
Have a seat, welcome.
Thank you. Good afternoon, Mr. Chairman, members of the committee. Tammy Johnson with Wyoming Education Association.
Speak up, because I can't hear you in the back.
Tammy Johnson with Wyoming Education Association.
Thank you.
I'm just here basically, since we're going to continue to revisit this bill, thank Representative Obermueller for sticking with it. It's a bill that we feel is very important to help solve or work on the education deficit. I like the new changes. My favorite part of the bill is the line that says 100% will go to the school foundation program. So any way we can get there, of course, we're in favor of. So I have a lot to say, but I think I'll wait till we revisit the bill at the next meeting. So.
Thank you, Ms. Johnson. Questions for Ms. Johnson? Thank you very much. Yep. So we do, I don't mean to cut off any public testimony, but we do have another presentation to get through, and we might have that presentation if it's all right with everybody, and then we can have more public comment. But Mr. Walczak, welcome. How are you?
Doing well, you, sir.
Thank you. Welcome. Do you need some help from LSO? And I think they're all on top of it.
Excellent.
Why don't you introduce yourself while he's passing it out?
Mr. Chairman, members of the committee, I appreciate the opportunity to be here today. I'm Jared Walczak from the Tax Foundation. We are a nonprofit tax policy research organization based out of DC. And I work on our state team, so I come and testify to a lot of state legislatures and work with members of the legislature in a lot of states to try to just help members understand some of the options that they have and to walk through issues like this. I do apologize for my voice. I know that without a microphone, it's probably particularly a problem, but I will try to get this out. Suffering some allergies because I love to be in your beautiful state, but I spent 4 days hiking and camping in your beautiful state before I came here to testify today, and apparently my allergies are flaring up from that. Went up some great trails, probably went down some deer paths, did not go into any rabbit holes, so hopefully.
Not yet, you're
Not yet, but I might be. I do want to actually address the throwback issue to some degree because I think it's important. I recognize and I respect that Representative Obermueller and probably others here would say even if throwback rules did not exist, this would be the right thing to do. And I respect that point of view. I do think that there have been some discussions in this state that have yielded confusion on exactly what throwback rules are and how they apply. So to the extent that that might be important to other people, I do want to spend at least a little time explaining how those work. It's certainly true that there are differences in how states approach this, but there are some pieces that are the same in every state with a throwback rule that I'm not sure have been fully understood. Which makes sense, because if you go to a state where they've had throwback rules, if they had a corporate income tax for 70 years and they have throwback, most of the members probably couldn't describe it in significant detail. It's not something you talk about much. In a state where you have not had a corporate income tax, this is a complex subject. It's something that I think that if it's a part of the argument, if it's part of the rationale, we want to go into a little. I don't know if this is going to work or not, so it might not.
But Dean's back there if you want.
But if you can, it would be possible if this is not going to work terribly well, does that like, could I get a copy of the slide deck too, or if we have an extra?
Sure.
That way I can just use that. Thank you.
And we can dim the lights a little bit. That seemed to help a little bit this morning.
Yes. Either way that works for the members. And Mr. Chairman, I would also say that with my presentation, this was based on language that has obviously changed some today. So I will do my best to update this based on what we now understand, but there will be a few statements on the slide deck itself that are no longer pertinent, perhaps, to the discussion before you.
We appreciate your flexibility, kind of the way we roll around here sometimes.
Well, I appreciate the opportunity to be here and discuss this. Obviously, Wyoming has considered corporate income taxes before. It's been a long time, but they were considered both individual and corporate income taxes during the Great Depression. Ultimately rejected by the late 30s, the decision had been made that the sales tax was going to be the way to go. And of course, as Representative Obermueller and others have commented, in 1974, voters then ratified a constitutional amendment that places some limitations on any income tax that you might adopt. In no way prohibits it from happening, but does provide this requirement that there be this credit against liability for sales, use, and other ad valorem taxes. And I know that the bill itself is saying excise taxes, severance, a variety of other taxes will be included in how this is handled. This bill, as I now understand it, is much closer to a traditional corporate income tax, though it is not quite what you see in other states. So one thing, the bill that I have seen is 24 pages. I do not know how long the new bill is, but my guess is it's still maybe within 25 to 30 pages in length. That is way shorter than almost any corporate income tax code you can find anywhere in the country. Part of that is a good thing. There's a lot of detritus in corporate income tax codes that you don't have to put in there. You don't have to put all of the credits that don't actually work, all of the incentives that tend to fail. There's lots of things where it's great if your code would be shorter if you had a corporate income tax. But there are also important structural elements that mean that usually these codes are a lot longer. And I fear that if this bill has evolved from this narrow tax based on corporate net income for a handful of industries into a much broader corporate income tax bill, that it's missing a lot of the important structural elements that are present in every other corporate income tax in the country. And I would encourage all of the members, as this bill has evolved, to consider, is this actually a corporate income tax as we would design a corporate income tax, as opposed to is this an expansion of the National Retail Fairness Act? As has already been mentioned, there's not a net operating loss carry back or carry forward provision in this bill. That is a very significant omission. No state denies some sort of carry forward provision.
I'm sorry, let's pay attention. Please keep the conversations low. Mr. Walczak, I apologize for that.
Mr. Chairman, thank you. Most states provide a carry forward of 20 years, or they match the new federal law of unlimited carry forwards, but with a limitation of it only being allowed to reduce your tax liability in any given year by 80%. You can keep carrying forward forever. Some states also have a carry back provision that has become less common, but there are only 3 states, I believe, that have short carry forward periods, like 10 years or less, or a cap on it. Every other state basically has 20-year or unlimited carry forwards. This bill does not have that. That is a very significant departure from what corporate income taxes look like. Already mentioned by others who testified is that that 100 shareholder threshold is unusual if you're thinking of an actual corporate income tax, because it does sort of distinguish between companies that don't really look in their structure that different from each other. The other aspect of this, though, as I understand it, and I apologize, without the language, I could be misunderstanding it, but as I understand it, this uses the Form 1120 as your baseline. There are some adjustments on whether you're liable, but you start out with, do you have to file a Form 1120 at the federal level? Now, S corps.
Actually, I think it just says, do you have 100 shareholders or not? That's what I think it says.
It no longer has. Okay.
I'm not sure about that.
Mr.
I
Chairman.
think that's the critical thing.
Okay. And Mr. Chairman, obviously, in either form, this captures S corporations, or at least some S corporations. That is also a fairly unique element among corporate income taxes. Florida, which does not have an individual income tax, is able to capture a tiny, tiny sliver of S corporations under its corporate income tax, but the vast majority of S corporations do not pay. Louisiana has a strange situation. They, of course, tax individual and corporate income, but their S corps generally pay under the corporate tax. Other than that, this doesn't really exist. You would be capturing S corporations, some of them, under a corporate income tax structure.
Mr. Walczak, I'm so sorry. I misspoke, so I want to get you on the right track. It says, and who files are required to file a Form 1120, not 1120S, with the Internal Revenue Service if the corporation or the affiliate group has more than 100 shareholders. I'll throw it back to you. I didn't know.
Mr. Chairman, thank you for that clarification. And without seeing language more, S corporations are required to file, but they're not required to pay. And you mentioned the 1120S, so I don't know. I don't have enough information to speak more on that. But if the impact is to tax some S corporations, that would put you in a very unusual position within a corporate income tax structure. So I call that to your attention. There are 3 broad. If we could maybe advance the slide deck one here, or move to the next page. There are 3 broad cases that I think have been made for this, and made by different people. I don't want to attribute or put words in anyone's mouth, but I think that there are 3 basic things. One is the revenue volatility and the revenue decline associated with heavy reliance on basically the extractive industries in the state. And you've seen this decline, you've experienced it in your revenue. The second aspect of this is the argument that national pricing strategies mean that chains in particular would absorb much of the tax with little or no incidence on Wyoming consumers. And then the third part is the belief, and I think Representative Obermueller disavowed this as a part of his proposed beliefs here, but others have raised the issue of the idea that throwback rules mean that at least some portion of this is currently being paid to another state, and Wyoming would be able to essentially capture that, to take it away from another state and bring it into Wyoming. So some portion of it would be net neutral, but bring it to Wyoming. I want to address all 3 of these at different lengths. Volatility issue, very real, very important. The national pricing strategies, I think there's certainly truth to it, but perhaps overstated, and I'll talk a little about that. And the throwback rule, which I want to spend a little time on right now, I think has been misunderstood. So I want to talk about that. If we could let's just jump a couple of slides to a map, if we could, given the changes in the bill. This is a map of states with throwback or throwout rules. Just for especially for anyone watching, not in this room, I imagine everyone in this room has now had some discussions of throwback and throwout rules. But the basic idea of these rules is that if you have a company that it has some operations in a state where it's subject to corporate income tax, and it has sales out of that state into another state where for some reason it is not subject to corporate tax. This is like the broad version of this. Then maybe you can throw back those sales into the numerator of your apportionment formula in the originating state and tax them there. And that is the way that this usually gets framed. And it's mostly accurate, but it actually doesn't take into account states like Wyoming and South Dakota, because for most states, that's not what they're thinking about. The real way that this functions, it's not a question of whether a company is taxed in the receiving state. It's a question of whether it is taxable in the receiving state. So it's really a question of taxable nexus. And companies here, even though they pay no corporate income tax, many of them absolutely do have taxable nexus in Wyoming. You choose not to exercise it. You choose not to tax them, but from a constitutional point of view, from federal law point of view, a company that has any sort of payroll or property, any sort of physical presence in this state has taxable nexus. You cannot, as another state, throw back their untaxed sales to that other state because you have nexus, and that is the standard, not that you chose to tax them. There was a discussion earlier about the developments in state laws on this point. So two particular developments. One is in 1957, the Uniform Division of Income for Tax Purposes, UDIPA. The second one is the creation of the Multi-State Tax Compact about a decade later. And that incorporates a lot of the UDIPA language and updates it. This is where throwback starts to come into place. This is also where you get apportionment. So 1957 is when you get the more uniform approach to apportionment. States had really gone their own ways prior to that, and Congress threatened them, and the solution was, okay, we're all going to mostly get on the same page. Over time, now they've actually veered away again, but for a while, most states decided we're going to go with this uniform division so that Congress doesn't impose its will on us, and we still have some ability to do this. Between 1957 and the late 1960s, when multi-state compact came into place, something really important happened. That was the 1959 adoption of what's known as Public Law 86272. Not a very popular name, but it's just a number, but 86272 says that states cannot claim nexus for corporate income tax purposes if the only activity of a company in their state is sales into that state. Now, the moment you put a salesperson in the state physically, the moment you process a sale with someone physically in the state or a property in the state, you have nexus for all of it. But until you do, simply having sales that are processed elsewhere, sent by common carrier elsewhere, it's not taxable. So, large corporation that sells to a retailer in Wyoming, if all they do is sell to that retailer and it's not on their trucks, or they're selling it directly to consumers and it's not on their trucks, they do not have nexus here. You cannot tax them under the bill that's being considered, and that is subject to throwback because you could not tax it. So that can currently be thrown back. Even if you adopted this bill, it could also be thrown back because you cannot tax it. On the other hand, if that company actually has nexus here, let's say they're a large multi-state or multinational chain, and they have a retail store here, and they're actually selling products to you. They have nexus here. You've chosen not to do anything with that nexus, but there's no state that is able to throw back any of their income into their originating state because that nexus exists, and that's the actual standard. Taxability, not taxed. It's not a taxed status. So this throwback argument, you're not shifting revenue from one state to another. You are taxing income that is going untaxed now, or you're trying to tax income that is already taxed in another state, but there's no scenario in which you can transfer it basically from one state to another. Another perhaps misapprehension, though less significant because that covers most of it, is that it's not, throwback isn't where the corporate headquarters is, it's where the transfer originates. So I've heard a lot about, like Arkansas keeps coming up, and I can imagine why. There's a pretty big retailer based in Arkansas. Now, I don't believe that retailer actually ships its products to other stores from Arkansas. It ships them from different places across the country, many of which don't have throwback rules.
Ship them from Cheyenne.
There you go. Mr. Chairman, so even if you had an arrangement where a company like this did not have any property, did not have any payroll in Wyoming and was shipping to third-party sellers in the state, just because their headquarters is in a state with throwback rule doesn't mean that they're actually shipping from a state with a throwback rule, which is what actually matters. But more importantly, the company that I think has been alluded to multiple times They clearly have stores in the state. I stopped in one of them a couple of days ago, and they own those stores. That's not franchised. So they're taxable here. They're not currently taxed, but there's no throwback that applies to them right now, could apply to them. Nothing you do changes their taxability in any other state. And that's true for pretty much all of the companies that you were considering under the original bill, because by definition, retail, lodging, all of these have a physical presence in the state. It wouldn't work otherwise. There's another variation on this where it's intangible property. So most hotels, I was lodging as part of the original bill, most hotels, they own the property. But I like to stay in budget hotels, and some of those are franchised. And of course, you also get franchised, fast food joints sometimes, where it's a local LLC that owns the actual establishment, and they're paying royalties and license fees to some company out of state. Now, in this scenario, you've got an out-of-state company that is selling intangible property into the state and might not have a physical footprint. In that case, you do have a sale that is untaxed in this state. It's a sale that's untaxable. Even though there's physical property here from the franchisee, if that company doesn't itself, the parent corporation doesn't have property here, you cannot tax it, period. Now, what other states can do is a little different, because intangible property is subject to throw out rules rather than throw back rules. The way they're designed, in some cases, they are able to throw that out of the denominator. I can go into apportionment if you want, but basically, you either add things to the numerator or reduce things from the denominator. Either way, it changes the share that's taxable in a state. So in some cases, the outgoing state, the outbound state, can tax some of that intangible income. Most of these big companies are smart enough to not place it in the state. You place your intangible property in Delaware, right? You don't put it in places where it's all going to be taxed. But theoretically, someone could do it in the way that it's taxed coming into Wyoming. Nothing you do can change that. And you can't tax that intangible income unless they also have physical property here. So I think there's been a lot of maybe confusion on that point in just general press, and maybe in understanding of many of those who have been thinking about this. I recognize for some this is a non-issue. Obviously, a lot of states have corporate income taxes. They don't say no corporate income tax because throwback isn't helping us. But given that I think there's been this perhaps confusion that some of this is simply transferring money from one state's coffers to your state's coffers, I want to make it very clear, none of that is happening. Every dollar that would be raised here is completely independent of all of the revenue that would be raised elsewhere. I think that's an important point to discuss. I had an example on throwback. I'm going to jump past that. I know that we're kind of short on time, or at least running late. If you could flip to, so jump past this, maybe flip to the economic implications slide here. I want to talk a little about the pricing question. It is absolutely true that if you go to a decent number of large chains, you will find uniform pricing, at least of certain goods, often not most. And this is going to vary a great deal. Now, I live in the Washington, D.C. area. I do not recommend living in the Washington, D.C. area. I shop for my groceries at Walmart because they actually are pretty good on groceries doing something close to national pricing. I don't shop at Giant or Food Lion or a bunch of others as often because they really don't. And their prices are significantly higher. Some companies do this, some don't. It is not as uniform as perhaps you might believe. The second thing is, no one or almost no one is truly uniform, even Walmart, even some of these really big chains, Safeways, Albertsons, there's differences. And especially there's differences on the products that aren't the nationally advertised ones. If you do a national advertisement of, come into our store, we've got this for $3, it's going to be that in pretty much every store that you control. But on the other hand, there's plenty of products that absolutely do vary from jurisdiction to jurisdiction. There's a lot of reasons for that because stores operate under pricing constraints. And honestly, Wyoming is going to be an expensive state for some stores to operate in. You have these trade-offs. In really high density areas, you have higher costs based on property values and on labor. Those things are much more expensive in other places than they are here. Here, of course, you've got transportation costs. You've got to ship most of the goods a lot farther to get here. And you have a significantly lower volume of sales per store, and often are drawing from a very large catchment area for those sales. There is, I think, a concern that at too high of a rate, that a tax like this could mean that some stores, especially some of like the lower margin retail operations, would be less competitive. And again, obviously, most states have corporate income taxes. They're not lacking for stores. But, I looked through, there are like of major chain grocery stores, there are like 20 some in Wyoming. That is not the way it works where I live or where most people in the country live. Grocery stores on average have a 2% profit margin that can vary a lot and it can drop below. And national pricing strategy or no, you can't operate all your stores in the state on a less than a 0% or a lower margin. You will pull them out of the state. The risk becomes in a state like this that no, the store in Cheyenne is not going to close down. But what if some of the stores in some more remote areas that mean the difference between driving half an hour and driving an hour and a half to one of these stores, what if it changes its hours, reduces its product selection to the highest margin, the most common goods, or even closes down? And I think those are concerns at a high enough rate. You and South Dakota basically are the states that forego corporate taxation in a broad sense. Nevada comes pretty close. And if you think about those three states, those are really the three you would come up with. Alaska would be number 4, and they do have corporate income tax. But 3 of the 4 states that have a huge, so North Dakota, I would throw in 2. North Dakota is a very low tax, and they have very low property taxes, very low tax environment. The moment those taxes get to more of an average of what other states experience, I think you run into some problems with those marginal stores. Of course, you're still going to have retail in the state. But even if you lose a store or 2 out of 20 grocery stores, like larger grocery stores in the state, that hurts some people. It hurts both employees and it hurts some individuals. So at least watch the rate on something like that. 7% would in fact be the highest rate on the first dollar of income, of corporate income, west of Iowa. That includes states like California, Oregon, lots of states that you might think of as higher. Now you do have this unique aspect that there would be a credit for other taxes paid, and that reduces effective rates. Other states have their own provisions that reduce effective rates. They have investment tax credits. They have R&D tax credits. They have jobs credits. They have all kinds of other provisions that also reduce that rate. And of course, they have net operating loss provisions, which are extremely important to companies that might have some changes across the business cycle. Now, I do not in any way recommend that you go down some of those paths. Generally speaking, broader base, lower rates is a much better policy. I'd much rather you have whatever the lowest rate you can have is than fill this up with investment credits and everything else. But be aware that even though, yes, you do have this one area in which you're reducing the effective rate, other states have plenty of their own. And you would have the highest rate on the first dollar of income of any state west of Iowa, which is a big jump from not having a corporate income tax at all.
May I interrupt you? Is that because they have graduated rates?
In a few states, it is because of graduated rates. So in California, Oregon, and Nebraska. I might be forgetting one. I think those are the 3 where it matters. It is because they have graduated rates. So in Nebraska, after $100,000, you get to 7.84, I believe. In Oregon, you get up. Oregon and California, you get close to 9 once you get to the highest levels, like over $1 million or more. Somewhere in that ballpark. I should know the exact, but it's higher than 7%. The rest of the states, no. I mean, most of them are single rate, and they're simply lower. They're in the 5s and 6s. Some of them are in the 4s.
Do some of them have a threshold for income?
No, not to my knowledge, Mr. Chairman.
Thank you.
Mr. Chairman,
Senator Ellis.
since you're going fast,
Now that you've
I'm
got
trying
a
to jump
fancy
in.
chair.
Mr. Chairman, just watching one trend in Wyoming, I don't know how I'm going to phrase this as a question, but I find a little bit concerning is some of our small towns rely on they don't have like a Walmart or a Target, it's a Shopko. And then, I believe Kmart and Sears are kind of on the decline. And so I'm wondering how that, the challenges that those particular companies are facing with their continued operations, how that fits into kind of some of this discussion that we're having. And again, I'm just, I guess, worried about some of our small towns in Wyoming having access to basic goods, Mr. Chairman. So I don't know how to phrase it as a question, but it's something I'm certainly concerned about.
Back to you if you can.
Mr. Chairman, I think it's a very important question, and it's more significant in, again, a state that has a very low density than it is in most other states. I do have a slide here. I don't know if we can find it. It's towards the end. It's a population density.
It's up there right now.
Oh, excellent. Thank you. Thank you for wherever he is for jumping ahead. And you can see that, Wyoming as a whole has a population density of less than 6 people per square mile. If you go outside of the 116 square miles that the 5 most popular cities include, you go down to 3.8 people per square mile for the rest of the state. Now, the median state, I checked this morning, the median state is Wisconsin with 106 people per square mile. Only, about 7 or 8 states are lower than maybe 40 people per square mile, and a lot of them are out in this area. The Dakotas, they're Nevada, there a few other states in this area. But this becomes a much more significant issue. It's not going to be hard to maintain a store here in Cheyenne, or maybe in a couple of other cities. But absolutely, to the question asked, there are some places where it is very marginal. When you think that retail, like grocery generally, and a lot of small retail or like general retail is a 2% profit margin on average. And then you think of just how low the population density is and the cost of transporting everything to those. I do worry that you do have some stores that are already probably just barely getting by that can't anymore. And I encourage you to recognize that this is a distinction against many of your peers with the corporate income tax and a variety of other taxes, that it's simply harder to keep some of these operations open. And there will always be groceries, there will always be retail in the state, but how far you have to drive is a quality of life issue for a lot of people. And I think that a broad enough tax at a high enough rate, you potentially put some of those at risk. I think that is a concern, Mr. Chairman.
Thank you. Keep going.
So I am sort of skipping around because I think that as the bill has changed, some of this is less relevant than other points. I do want to sort of just briefly address again that revenue volatility issue. It is serious. I don't want to in any ways underplay that element. States that rely heavily on extractive industries have boom years and they have bust years, and the bust years can take a long time, and it's not necessarily a great place to be that reliant on 1 or 2 industries, which is what you and a handful of other states are. And this shows up in a lot of taxes. In most states, the sales tax is a fairly stable source of revenue, declining a little because bases are eroding as more people consume services, but it's a kind of flat, if slightly declining trajectory. Here, it has been highly volatile. And that's partially because the sales tax is also falling on significantly this industry that has these highly volatile prices. In an ideal world, a sales tax would not fall on business inputs. In a real world, it does to a significant degree. So your property taxes and your sales taxes are also fluctuating with the extractive energy industry, especially the energy industry. You have this volatile revenue mix, and over the last couple of years, that has not looked particularly great for the state. I think that there are potentially several things to be done. Obviously, the proposal on the table is one of them, going to some sort of income taxation, whether that's corporate or individual. On corporate taxation, most states are going in the other direction. There was a discussion earlier of gross receipts taxes. Our position is that those are a very bad idea. I can go into that for other reasons, but it sounds like that's not really on the table at the moment. So I'll set those to one side. But one reason why a couple of states have looked at those recently is because corporate income tax revenues are shrinking every year. Prior to the 1986 federal tax reform, corporate income tax revenues might be, 15% of the state's budget, or state's tax revenues, rather, the budget's different. 15% of state's tax revenues. Now they're usually under 5%. In many states, they're 3%. And that's a lot because companies have shifted their formation. They're now S corps rather than C corporations. It's changes in what sort of income counts. It's changes in tax planning. There's so many different reasons why this is happening, but it's a declining source. And states, I don't want to say they're getting out of the corporate income tax game, but they are certainly relying less and less on it and accepting that. 16 states have cut their corporate income tax rates since 2008. I think only 3 or 4 have raised them since that time, because in some ways they're looking at it and saying, if we can be a little more attractive by cutting this rate, it doesn't even cost us that much revenue anymore. It raises that little and it declines. So let's consider doing this. So you'd be going in a very different direction than most states. Obviously, most states have a corporate income tax, but pushing in that direction, especially going to a fairly high rate tax, would be pushing in another direction that still has that volatility. So corporate income tax is one option. The sales tax itself, you have a broader than average sales tax rate, but sales tax base, but a lot of that really is business inputs. There would be an opportunity potentially to expand that base to include more high-end consumption. Most sales tax bases, not just here, are primarily based on goods, not on services. And of course, more and more of our consumption is service oriented. So states are starting to tinker around the edges, at least, of taxing more services. Utah right now is looking at a very serious expansion into services. We'll see what comes of that. I'll spend some time with legislators there on that issue. That is a way to perhaps generate some additional revenue. And in this state, at least, it may be less volatile than the rest of the sales tax because you have this volatility built in from the industries you have. In most states, I don't think that distinction exists, but here it may actually make the tax more stable. It certainly would bring in additional revenue. That would be an option also on the table. Obviously, there's things you can do with rainy day funds, but you've already done some of them. There's only so much you can do with the volatile and potentially declining revenue sources you have. So I recognize the constraints you operate under. I recognize the reason why Representative Obermueller and many others want to do something on revenue, and we'd love as the Tax Foundation to be part of that conversation. If you do want to pursue additional revenue, we want that to be as structurally sound as possible, and we'd be happy after this at any time to discuss that with you, Mr. Chairman, or any members of the committee or the legislature, how to address that. But if you're thinking about a corporate income tax, think about it as a corporate income tax. Acknowledge that that's what it is, because I think that's important just to acknowledge this is now basically a corporate income tax, which is something the state has long chosen to avoid, but also acknowledge that it needs to be designed as one, because I very much fear that as this has been scaled up from a narrow tax on 3 industry codes to a corporate income tax, there has not been enough work to bring in the structural elements that we think of as part of corporate income taxation. There are a lot of pitfalls associated with doing that. I don't think a 24 or 25 or whatever number of pages bill this is sufficient for a modern economy to impose a corporate income tax. You don't have definitions of tons of things. I don't know if you say that you use federal income tax definitions in this bill. I don't think you do. I'm confident that you don't have a deduction for foreign dividends received or other international provisions. I don't believe you have a federal depletion allowance. There's just so many different provisions that usually end up in a corporate income tax that are not part of this, even setting aside the really big elephant in the room, which is the net operating loss provisions, without which this is an extremely punitive tax on businesses that have a longer business cycle, which would include, by the way, a decent number of your extractive industries. And I recognize the severance tax might be enough. The credit for the severance tax might be enough to cut it. I don't know. If that will always be the case, I simply don't know what their books look like. But to the extent that any of your extractive industries actually have liability under a corporate income tax, you know how volatile their business cycles are. You know that they have significant losses in some years and significant gains in another. If they can't smooth that, you're putting them at a significant competitive disadvantage against the rest of the states.
While you're thinking there, so roughly the extractive industries, we have ad valorem taxes with severance and the property tax on an ad valorem basis works out to be about 12%. So I think it's pretty hard for a mineral company to actually, it's producing anything to get involved in this.
Mr. Chairman, I think that sounds right to me. Thinking out loud as this bill's changed, about these provisions,
Sure.
But that sounds right to me. There could be scenarios, maybe if they've idled some wells, but still have,
If in a particular year their income came from somewhere else, they sold some property, I don't know. Yeah.
There could be scenarios, I think in most cases, that would not be a concern. You are using a 3-factor apportionment in this bill, which a lot of states have moved to single sales factor. There's nothing wrong with 3-factor. In fact, it sort of makes sense for a state that does have those industries because they have pay more on property that they can't really move. The
Right.
oil, the natural gas, whatever is being mined, it's stuck here. So it sort of makes sense that you double down more on those. A lot of states have gone to single sales factor to export more of the tax burden. But you do have this somewhat of a tension where some of the selling point of this is we're bringing taxes from other states, but you actually would be adopting an apportionment factor that is much more focused on taxing in-state activity than where most states are. Something not necessarily bad, but something to be aware of as you're comparing this to what other states have. Again, I had other testimony prepared. I think that some of it has become less relevant because of this, and I also acknowledge where we are on time. So maybe with that, I would simply say there's uncertainty in any of these revenue projections. Creating a new tax always has this, but particularly if you're going to have thresholds on things like shareholders, that's not readily reported data. You know, even income thresholds would be tough to model, but easier to model. You know, I would not envy the task of those trying to determine what the revenue of this would be. And I do think there's some non-neutrality and tax avoidance that absolutely comes out of that. And I'll wrap it up with that and be glad to take any questions.
Thank you very much. I thought your testimony was very strong. I'll make one point before we open it up for testimony or for questions. You mentioned that we have a cyclical economy and it's a boom and bust, you know, and you very carefully build that out. We think we might be actually entering into a new phase. It's not really boom and bust. It's that concerns about global warming have perhaps just begun to cut the heart out of what we produce. And it's not just a cyclical downturn. It's actually, I mean, coal may be gone forever in the next 10 years. And we actually worry that possibly oil might go the same route. And natural gas or other piece of that may be a little better, but maybe not. So it's more than a dealing with cyclical variation. It's actually that we might be looking at structural changes that really will fundamentally alter where we get our money. So with that, let's open it up for questions from the committee. Oh, this is extraordinary. Representative Roscoe.
Thank you, Mr. Chairman. Mr. Walczak, just quickly, because most of this is over my head. But with corporate income taxes, you say in other states going down, when the stock market's hitting record highs, just quickly, how does that happen?
Go ahead, Mr. Chairman. You know, to that question, it is a variety of reasons. It is choices that states have made in policy to create significant credits and incentives that have carved out much of their base. It is a shift in apportionment to make it more attractive to states that sometimes also carves out that base. It is this long-term change that we have seen with fewer and fewer companies actually being a C corporation. It is overseas operations. There are lots of different pieces of this puzzle. Now, that doesn't mean that in the short term, like in the last couple of years, some states haven't seen a bit of an uptick. I think a decent number of them have. Some states have exceeded expectations for this period. But if you zoom out more than a year or two and you look at the trends over 20 or 30 years, it is significantly declining and will probably continue to.
Anybody else? Senator Biden.
Mr. Chairman, thank you so much for your testimony. Sticking to the tax avoidance issue, could this possibly turn out as you mentioned, you know, not very many companies are electing VC corps. Could this eventually turn around and bite us where the people that can avoid this tax will relocate elsewhere? And the people that are stuck here, that have been here forever, that will try to maintain here, will end up paying the majority of this corporate income tax, including our extraction industry.
Go ahead. Chairman, to the question. Yes, I think there's a couple of things maybe to quickly tease out here. One, most of the literature suggests that there are elasticities of -0.3 to -0.4% for corporate income taxes. What that means is that for whatever every percent increase, if you already have a corporate income tax, every percent increase in the rate, you're only actually picking up 0.6 or 0.7% of revenue because of changes in business activity. Some of them are avoidance. Some of it, they're still investing just as much and they're just avoiding the tax in various ways. Some of it is migration. Some of it is changes in business activity that are relatively inefficient. But there's this economic drag associated with a corporate tax. Some of this, the fact that you already have to pay at the federal level, the decision on whether to be a C Corp or an S Corp is going to be driven much more by the federal tax regime than by anything you do. And most of these companies many of these companies that are S Corps are operating in multiple states already. I would not anticipate a significant shift from C to S based on this, but I would say that there are other opportunities. To my knowledge, this bill really doesn't address anything about how affiliates and subsidiaries are treated. It does not say whether you are to be a combined reporting or a separate reporting state. I assume that in the absence of a statement, you'd be separate, but that's an assumption on my part. I don't believe the bill specifies that. I don't know what the nexus provisions would be for the affiliated unitary group if you went that way. So there are potentially opportunities for companies to have affiliates that might be under a liability threshold or operate in different ways. I think the way this is designed, there are lots of ways to arbitrage within this tax because it'd be relatively easy for the company with 100 plus or 100,000 shareholders to make sure that their actual operations in Wyoming are under a different entity that perhaps doesn't owe taxes. Probably not going to change a lot of whether they do business here, but they can potentially change whether they're taxed here. I think that's a concern. And some companies will have that ability. Others, that will be too costly or too difficult. And in some ways, you end up hitting not the smallest businesses because they're not going to have 100 shareholders, but the mid-range businesses that have trouble doing tax arbitrage at the same level that the largest multinationals are able to do.
So, Mr. Walczak, do you have a follow-up?
No.
Okay, let me get your point also about the subsidiary. Say you had a very large corporation that they just formed a subsidiary to be in Wyoming. It's a wholly owned subsidiary. In essence, there's one shareholder to the subsidiary. Is that what you're getting at?
Mr. Chairman, yes, I think the way I understand this to be currently drafted, and I need to be careful because I haven't seen the final language.
I'm trying to understand the significance.
Yes, I believe that you could create a scenario in which all of the operations of a large multinational company, in some circumstances, could be handled by a subsidiary that has one shareholder, and therefore is not subject to tax, where you could break things out in a variety of different ways. There are lots of detailed questions that usually get answered in corporate codes or in regulations on this. Within say combined reporting, there's rules called like the Joyce and Finnegan rules, which address how you determine whether nexus is achieved based on the unitary group. I don't want to go into all the details, just to say like there are hundreds of cases, thousands of cases. There are all these provisions that have been hammered out in other states and that are usually brought into any state that has these taxes because they have very similar language on a lot of provisions. That's why this Uniform Division of Income statute exists. It's why multi-state tax compact exists, so that the litigation in one state can strongly inform how it works in every other state as well, at least most of the other states where the provisions are similar. You draw in this bill from some of that language. There are lines that are actually pulled from the MTC model legislation, but you're missing an awful lot of it. It's a long document, and it's usually one small portion of a state's corporate code. I don't think you should adopt a significant amount of what some states have, because again, they've larded up these codes with a lot of incentives that probably aren't doing a whole lot of good. You don't need to adopt everything, but structurally, this isn't what a corporate income tax usually looks like. And I worry that there are a lot of unintended consequences of having a bill this short creating a major new tax.
Committee, Representative Larson.
Mr. Chairman, thank you. Thank you for coming and testifying. I think during your testimony, you said that revenue raised in this bill is not revenue in another state currently. Is that correct?
The Chairman, yes.
He said yes.
Yes. And if you'd like me to clarify briefly.
Please.
So imagine a company in a neighboring state, we'll say Nebraska, and it only has sales into, or nearby state, nearby, but like only has sales into Wyoming. Right now, they can tax that sales income that comes into Wyoming because that company has no nexus with Wyoming, whether you had a tax or not. They have no nexus, so they can throw back some of that income if they choose, and they do in fact choose, and they can tax that. If you impose this tax, you still don't have nexus with that company. You still can't tax them. Nebraska can continue to throw it back. Nothing has changed. Now imagine a different scenario. The Nebraska company also has a sales office here, or they have a retail, whatever they have, a facility here. Nebraska can't touch a dime of the Wyoming sales because they have nexus in Wyoming, so they can't throw it back. It doesn't matter that you've chosen not to tax it, they cannot tax it now. So your decision to tax that income, you can certainly do so, but it doesn't change anything about what Nebraska is doing. They're already not allowed to tax that income.
Representative Sweeney?
Thank you, Mr. Chairman. So is it the knowledge of your organization that basically, because we've never had a corporate income tax, we shouldn't even explore it? And, or do you believe this is at least a good starting point for discussion? And just because we've never had a corporate income tax, we should explore it, or just stay away from it because, in your opinion, the rest of the states are screwed up?
Mr. Chairman, to that question. Well, firstly, in many, many ways, just not just this, the rest of the states are, in fact. But that's just the way that tax codes and probably all statutes work in many respects. We tend at the Tax Foundation to be critical of state corporate income taxes, which is not to say that we're out there saying every state should repeal them. We're not out there doing that. But we do, when we look at the efficiency of different taxes, which is to say, how much does it change economic decision-making per dollar raised? Corporate income taxes tend to be among the least efficient taxes. It changes business decisions, it changes investment, it changes location decisions. And your ideal tax is going to have the least possible impact on economic decision-making to raise the revenue that it needs to raise. Corporate income taxes do fairly poorly on that measure, and they don't raise a whole lot of money. Given that they are usually 3 to 5% of the state's tax collections, we do generally see them as a tax that ideally states would be moving away from rather than moving towards. I do not, again, tell every state they need to repeal the thing. And I also don't say that simply because you don't currently have a tax that you should never explore it. You do have some clear revenue challenges, and I think that there needs to be a discussion. I don't love the idea of raising taxes, but I'm also not someone who says that under no circumstances should you raise additional revenue. You need to be able to fund basic services, and you need to be able to handle the fact that if you are losing revenue in one area, Mr. Chairman, to your point, if you have a secular decline in the industries from which you generate most of your revenue, then you do need to have a discussion about how you replace that revenue. My contention would be that the corporate income tax should not be where you start in that conversation because it does not actually raise that much money, and it will have more of an adverse impact per dollar raised than other alternatives. But I'm not here to say don't look at taxes, or even to say don't look at the corporate income tax. I respect that you need to look at all the options that might be available to you. I would encourage you, to the extent that this has now become a discussion about corporate income tax and not a corporate income tax on 3 NAICS codes, to take the step back and say, 1, do we want a corporate income tax? And 2, how do you design a corporate income tax for the 21st century, as opposed to how do we expand this small bill into a corporate income tax?
Thank you, Mr. Chairman. You must know some numbers we don't know, because you just indicated that this is going to raise a very small amount of money in the scheme of things. We aren't privy to that information. Could you share your data?
Mr. Chairman, I do not know the dollar amount that this will raise. This bill has obviously changed a lot since, at least to my knowledge, as I understand this bill, it has changed a lot since I got here today. So I cannot give you a revenue estimate. I can only tell you the experience of other states which is that it's usually about 3 to 5% of their total state tax collections and declining. Now, you are a state that already has, your tax collections are different than other states in many ways. You have actually, pretty high per capita collections,
But we don't
you don't
pay them that way.
but you don't pay them that way. Yes,
Right.
but that actually suggests to me that it would be even lower when you think about the grand scheme of things, where the revenue is coming from, what sort of economic activity is in your state. I'm guessing here because I don't have data in front of me. This bill is, as it exists, is new to me right now. I would be very surprised if even at 7%, this was able to be more than 4% maybe of your state collections. And that is up to all of you to decide whether that's a significant amount, but that would be probably the ballpark of where I put it.
And Mr. Walczak, I don't know if you were here for Representative Obermueller's presentation. There's another piece of this that perhaps we're not articulating very well, but Wyoming is kind of unique in the fact that a lot of the economic activity that happens here is driven by things outside of Wyoming. In an increasingly corporatized world, internationalized, so we don't necessarily have a lot of homegrown value. And I would bet if you looked at multipliers, our multiplier is about probably as low as anybody's, the economic multiplier. It's going to be as low as it can be. So part of this driver is a feeling that we're trying to break out of our so-called colonial model, which has served us well when we had a good tax policy with respect to some minerals. It wasn't all bad. But we don't quite understand how to transition here. And we are very thin markets. You mentioned the population per square mile. I mean, that's it. We have a unique problem to try to fix that. So I think that's part of the driver of why this seems appealing to many of us, is that, everything goes out of Wyoming. Let's try to grab some of that goes out. And I think that's the same with our discussion about wind taxation. It's about a lot of what we do here. So how we can export taxes is really big for us. So can you give us some advice?
Mr. Chairman, firstly, I think that's an excellent point, and it's a very serious consideration. And I want to make a major distinction between Wyoming and some other states in which I testify. There are some states that I think are looking to wring every last dollar out of their economy. That is clearly not what Wyoming has ever done, and that is clearly not what anyone here is discussing. I think that this is coming from a point of needing to have a more stable revenue source and trying to address, as you say, those disparities where a lot of the money is going out of state. I don't believe that sort of the protectionist model works well at the federal level. It certainly does not work well at state levels. It is true, of course, that you have lots of economic activity in the state that is being run by companies that are headquartered out of state. Very significant number, more significant than most states. Those companies are still employing people in the state. They are still selling things to people in the state that people want to buy. And I don't say that it wouldn't be nice if you had more homegrown businesses. I think it clearly would be nice if you had more homegrown
Our main
businesses.
streets would look a little better than they do right now.
But I do not know, Mr. Chairman, that these tax changes would create more homegrown businesses. I fear they would simply thin out some of the activity from the businesses that are here. Again, going back to that population density question, the margins that exist in other states simply aren't here. There are businesses that wouldn't flinch at this sort of tax in a lot of other states, but might not be able to operate 40 miles out of Cody, Wyoming under this tax provision. And to put this in really stark terms, you look at the tax codes and the tax rates in, say, like New York or California. They're incredibly high, and yet these states still have a lot of economic activity. There's a huge advantage for a lot of companies to being in New York City, and I get that. And they're willing to pay a lot, not just in taxes, but in every other cost that you have to pay to be in New York City. You put New York's tax code on Wyoming, I don't think you can have economic activity here anymore. You put California's tax code here, it doesn't work. And I think that the states need to accept those distinctions. And I worry that with the population density here, that you wouldn't be encouraging more homegrown, mom and pop shops or local businesses, you would be thinning out some of the activity that's happening in the less populous areas, or, you know, changing the activity in some ways. And that's a concern, I think.
Thank you. Anybody else? Thank you, Mr. Walczak. Really appreciate it. Thank you. Stick around. Let's see. We had agency discussion and public comment. Is there more public comment? There was some before. Come on up.
Good afternoon, Mr. Chairman, ladies and gentlemen, thank you. Like a couple of the other folks that spoke already, I'd like to just thank you for your efforts. Ever how this thing comes out, I'm a proponent of new revenue sources. Mr. Chairman, you said it really well, that we're not so much boom and bust as we are bust and bust and bust. I specifically want to talk about public education. I think that's the #1 priority of state services. And as I first started to think about it, my daughter is a high school teacher across the interstate there at Central.
Mr. Chairman.
I'm sorry?
Mr. Chairman.
Oh, yeah.
Would you mind asking that?
I'm sorry. Would you introduce yourself?
Sorry, Eric Dalton. I live here in Cheyenne.
Appreciate it. Thank you.
Sure.
Thank you, John, for catching us on that.
So my daughter's a teacher, so obviously I have an interest in that regard. And then I have a granddaughter that's about 3 weeks old. So I'm really interested in public education in that regard. So I started by thinking about the two of them. But we're very lucky as, you know, teachers are relatively well paid in Wyoming compared to other states. I'm gonna get rich doing that, of course. And then I'm also lucky that my son-in-law has a great private sector job here in town. So the more I thought about it is I thought about my granddaughter's colleagues, you know, because as you know well, the poverty rate for children is much higher than for the rest of us. And so, you know, I think of it as kind of a death spiral where we do a constitutional amendment and we change how we're obligated to provide education, and you get to this private voucher, you know, scenario that, you know, many folks advocate. And I'm just not a fan of that because, you know, my family might do okay in that sort of scenario, but society is going to fail in the long term. So I just wanted to applaud you for your efforts to find new sources of revenue and to recognize that we're probably not in a sustainable environment long term. So that's all I want to say. Any questions?
Thank you very much for that. Anybody? Thank you very much.
Thanks, sir.
Hello, welcome back.
Hey, how's it going?
It's okay. It's been a long day. But you
let's
have to
say-
introduce yourself again.
I'm Marcy Kindred from Cheyenne,
Great.
and I want to thank you for going overtime and all of the work you're putting into trying to fix these issues. I had something else prepared, but after hearing a few of the presenters, I've made some modifications and simplified. Simplified too, yes. It sounds like those opposed to this bill are grasping at some form of the statement that it's so close, but it's not quite there. They seem to be trying to coax this bill into being some vague definition of a perfect corporate income tax, except don't call it that because we don't do that here. It may be a pessimistic view, but I'm just gonna go out on a limb here and say that no matter what form of this is presented, it's gonna be so close, but not quite there. It's never going to be perfect. And as the mother of 4 children in Wyoming's public schools, I just wanna point out something that's also not perfect. $100 million cut from our public education system in the last 4 years. More cuts to education before some form of this is passed would be shameful. From what I understand, the reason that this was not passed the last go around was because it singled out the biggest corporations unfairly. I'm no expert, I'm not claiming to understand. But then we expanded it. Let's not go out back on our word. I'm so dang proud that my children are receiving a Wyoming education. I'm proud to live in a state that values and prioritizes education in general. It's something to brag about, and I do often. Don't take that away from us. No more cutting into Wyoming's children's education, our future. The last presenter laid out some other options to consider to address our deficit. Unfortunately, those aren't on the table. This is. And with all respect, he's not from Wyoming, and I don't know if he understands how difficult it is to pass any sort of tax, anything in Wyoming. This tax is as good of a place to start. Please pass this bill. Thank you.
Thank you. Anybody have a question? Nicely done, thank you. Anybody else? Anybody else on public comment on this? Committee, you've heard the testimony. We've had a couple of bills. We didn't talk about the bill that was noticed to the public, so we can't do anything final on the bill. But the question is, shall we carry the bill forward as with some kind of proposal? And Representative Obermueller, would you like to have a rebuttal, I guess, before I get too premature?
Thank you, Mr. Chairman. I wasn't going to have any comments if you were just going to take the project and move it, since it was sort of introductory today. But if there is going to be a vote, I do need to address some of the items that came up.
Well, the committee has to give us direction.
Yeah, thank you, Mr. Chairman. First of all, on page 24, line 12 of the draft bill, the issue of affiliated groups does come up, so that the large corporations can't game this thing by creating a subsidiary of one shareholder. We're trying to address that. I think that piece needs to be looked at more closely to make sure that it covers all the affiliated situations that we want to address. But we are trying to address the affiliation item. The item that Senator Whiteman brought up, Mr. Chairman, about people leaving the state, leaving our companies with 100 shareholders holding the bag and moving out somewhere else to reconstruct themselves. The whole point of the 100 shareholder threshold is that you must file 1120 at that level. This takes us out of the world of 1120Ss and partnerships and LLCs and all of those other structures. You must file as 1120. You must pay taxes at the entity level. That's the whole point of the 100 shareholder in terms of technical issues. The other point of the 100 shareholders is that there is a, if you want to call it a discrimination factor, that's what tax law always has something up its sleeve. And this is a special group of taxpayers. And what I'm trying to do in this bill is take the homegrown companies that we have here and allow them to make as much money as they want to. If they have one shareholder and they're making $1 billion, it's theirs under my bill. I'm not doing this thing that he's talking about. This is unique. This 100 shareholder is unique in that respect. Because if it's a Wyoming company and they have less than 100 shareholders, they decided to constitute themselves that way, they can make as much money as they want as theirs. So this idea that has to be, everybody has to run through filters and everybody has to be taxed, no. And there are other states that don't have individual income taxes. And so this is a very unique approach to protecting our Wyoming-based companies. I've heard this from companies around the state that say, you know, the only reason, and they're small, they have less than 100 shareholders, they say we stay in Wyoming because of this environment for us. But they, as soon as they reach a certain threshold, they make corporate decisions, do they not? And they get big, and now we want to have more than 100 shareholders because we want to go public and we want to build our wealth around the expansion of the global economy and leverage on our stock. That's what you do when you go with that many shareholders. So it's a decision that they make, and you see that in your own communities. Company really gets good, do they stay here? No, when they go public, they leave here. We have several examples of that out of the state. So this is to say, we value our homegrown companies. We know they stay small. They can make a decision to stay small. The Vail Corporation was a perfect example of that. They were a Wyoming company. And then they decided, hey, we can make a lot more money by leveraging this, become part of Vail, which is a $2 billion something company a year. Pays state taxes in 8 other states. They made that decision to leverage their position and to make a lot more money. And now they say the billionaire, who apparently is going to pay 37% on his income, now all of a sudden with their 21%, they're gonna be at this huge disadvantage. And they have the ability to spread their little tax to Wyoming, whatever that amount is, over a very huge company. That's one of the other things that we need to talk about in terms of the company that's in trouble in the small town, Mr. Chairman. Like this is the last straw. First of all, it's very important to know that this is not a tax on net Wyoming income. This is a little slice of their national income. Everything pours into a funnel, goes into a tax return, and then it's allocated based on their proportionate share of sales in the state. But we're picking up a piece of their little national income. So as a national organization, are they going to kill their store in one of our little towns because maybe there's some allocation back to Wyoming? Well, the store in Wyoming doesn't file a tax return. That's a home-based process coming out of some home office. That's a huge difference between our own little companies. So you want to talk about fairness? If we taxed everybody the same, then the local business would pay the 7%. That would be money just right out of their pocket into the state of Wyoming. With these multinational companies, they get spread over their entire stockholder base. So that makes a huge difference in terms of impact. The declining C corporations, well, that's happened over time because the number of shares went up. I can't remember all the steps, but it hasn't always been 100 shares. It started out at a lower level, and as it grew for more shares, then more companies could elect S corporation status. That was part of the reason why we have fewer C corporations. I'll bet you see it go back the other way now because of this 21% rate. Rate cutting in other states. We have, are you okay?
Are you awake?
Yeah, we shouldn't do this because other states are cutting their rates, right? They're not cutting them to 0. Iowa has a 12% rate and they're thinking about cutting it to 9.5. So, I mean, we're talking about these marginal reductions in corporate rates for whatever the reason. You don't see anybody dropping their state income tax, do you? Mr. Chairman, the next issue is, well, it's such a small part of their income, a small percentage of their income. That's because it's a part of a calculation that includes all their personal income tax. Here we don't have that. That percentage has got to be better here because we don't have that broad-based tax if you exclude energy taxes from that formula. And the other thing is, like 45 million, that estimate that was there before, from these national think tanks, that's not much money, but to us it is. It's a lot of money. So to say, well, it won't raise anything, that's an environment where that's the pocket change. But here it means something.
It's fun to get them wound up, isn't it?
Yeah.
The last thing I would say, panel, is do not let the fear model in terms of protecting ourselves in the global market. The fear model is not the way to go here. It's not like we're inventing something new here. We have 48 other states that have led the way. And I hear this fear model. It's George McFly attitude. We're going to lose our job. The world's going to come down around us. George McFly, Back to the Future.
Marty McFly's dad? Okay, I'm with you now.
Which he kind of looks like a little bit.
Thank you, Mr. Chairman. Do not let the fear factor drive your decision about this. Drive through your fears and start to think in terms of protecting the state of Wyoming in a global economy. That's what this is all about. That's what we need to do. Thank you, Mr. Chairman. There were probably other things that I missed, but I will cut it off there.
Mr. Co-Chairman has a question.
Thanks. Well, I would say, 3 to 5% as was testified, that's $150 million. So, I mean, that is not small change for us. My question really goes back to Mr. Walczak when he talked about how that maybe this bill is not as robust as you would see a corporate income tax in any other state. And I'm sure over time, you throw rules and regs and increase the statutes, but would you agree that we talked about maybe 4 or 5 issues that both Jared and other people brought up that we really should be included in this, if this is a corporate income tax on provisions? I don't know if you had any thoughts on maybe the 4 or 5 you mentioned, or is it fair to say that if this bill moves forward, we could ask for more input on specific provisions to be included?
Mr. Chairman, I agree. I wrote notes on the items that we thought were missing from here, and I'll work with Josh on including some of these, like the carry forward provisions. I knew we had some holes like that in there. I don't, the idea that it needs to be 100 pages to be a good bill, I just do not buy that. I've worked in this field a long time, and the reason for those huge bills oftentimes are pretty crazy, so.
Okay. Thank you, Mr.
Okay, anybody else have a question for Representative Obermueller at this time?
Mr. Chairman.
Representative Sweeney.
Thank you, Mr. Chairman. First off, Representative Obermueller, thank you for your work on this and trying to refine it. I hope that we can at least continue the conversation, that this is at least a draft and a good starting point, and I appreciate your efforts. To the argument of that we've heard that some of the companies may leave because of this tax. A couple of them were just mentioned in passing, not to single these out, but Shopko's already left, unfortunately, because of business decisions. I hated to see that one leave because they serve places that didn't have a Walmart. We recently lost in Casper one of our Midway's grocery stores. It wasn't because of tax decisions. It was economics. Do you see, in your estimate, if we were to put something in place, do you see any evidence in putting all of this together that we might lose some of those, whether it's retail or hospitality or a corporation out of the state?
Mr. Chairman?
Go ahead.
Thank you for the question. It isn't, in a broad general sense, taxes don't put companies out of business. Lack of profit does. One of the things that, because if there's no profit, there's no tax in a net income environment. That's the one advantage of this approach rather than grocery receipts tax approach. And that's a good criticism of grocery receipts tax. You take a company that's troubled, like you referred to, and a grocery receipts tax could very well be the last straw. But in a troubled company with a net income tax, if you take it as a standalone company out there, let's say we have a company in the state that has 100 or more shareholders, more than 100 shareholders, the standalone company be caught up in this, and they're a troubled company and are showing losses. They are not paying anything under this tax bill anyway. So the big stores that have shut down in Casper, that isn't because we were taxing them to death, that was because they couldn't make a profit. They need to have volume in their business to make them fly, and they're eating each other up with Amazon and other services. So in my opinion, it's profits that will keep companies in our state, even with a tax regime, just like every place else. Tax policy has little to do with it.
Thank you. Anybody else have questions for Representative Obermueller? Let's just scoot back. We're going to just have the committee talk for a while. So thank you. I want to make sure I didn't cut anybody off.
Thank you, Mr. Chairman.
Thank you very much for all your hard work. Discussion committee. Senator Ellis.
Thank you, Mr. Chairman. I have a question. I'm looking at our interim approved topic list. And initially, 220 came under priority of 4, which says National Retail Fairness Act. And so this is truly a question. Are we allowed to consider a corporate income tax bill during this interim as a committee bill? The way I read this, it seems pretty limited to talking about retail fairness and the NAICS codes.
Senator Ellis, I think absolutely we are. It's an evolution of the concept, and I don't see that as being restricted. I personally don't feel that at all. If someone wanted to lodge a complaint, you go to management council and take it up that way, and that'd be your right, it'd be okay. But this is so close to that, really. And it is a refinement to address some of the concerns about broadening it. So I would rule as the chair that it is within that purview. And, frankly, I'm not the biggest person of what management council tells us to do anyway, so I'll put that on the table. But you'd be perfectly right to challenge my ruling on that and go to management council if that were something you wanted to do. And I wouldn't hold it against you if you did. But I don't think management council will pull the rug out on it. Senator Biden.
Yeah, Mr. Chairman, to follow up on that, because I've been sitting here thinking about being the new guy, I wasn't sure if it's normal for what seems to be a personal bill to be worked brought to a committee and worked by the committee for the committee to then sponsor it as a committee bill. Does this normally happen?
Well,
you go ahead, Mr.
I would say it does normally happen, regardless if it's a separate bill or someone brings enough amendments. I mean, this bill before us is 95% the exact same wording, minus some NAICS codes. And I've done that before, bring a personal responsive bill and ask to make it a committee bill if it was in the committee's purview. And I would say, I don't think management council would have any concern, the evolution of 220 to this. There are some cases, at least on Corp in my previous life, that some bills came and both Senator Case and I said, yeah, that's a little too far from the scope. I don't see this one being too far from the scope, but I know, but it's routinely been done that people bring individual bills and members of the committee or the members, other legislators have said, can you make this a committee bill? It goes in with your mission. I think Reverend Sweeney did that with the sewer infrastructure bill on Corp 2 years ago and said, this is with the mission. It's my personal bill, but it's this topic, and the committee and Corp said, yeah, we agree. So it has happened.
So I see the change from this is that it's an amendment to the bill that got rid of the NAICS code restriction. That is the major thing that's happening here. Now, how that can't be germane, I fail to see. I think it is a big enough change and affects new people that I would be uncomfortable working the bill and voting it today. But to carry it over and give our populace the chance to comment and think about it, I think we're being responsible. Representative Blackburn.
Mr. Chairman, I guess the only thing that really bothers me about all of a sudden we have a brand new bill is that I think most of us try to come prepared to these committee meetings. I mean, I've got lots of things to try to help the National Fairness Bill pass. And the one thing that I dislike, I guess, the most about is getting information right now that we haven't looked at. I know you want to try to carry it forward, but it's almost to me like we're trying to slip something by. I just feel real uncomfortable with this. That's all.
Okay. Just to be clear with the audience, I'm not asking for a final vote on this bill. I'm asking it to be carried forward to the next meeting.
I understand that.
So you can do all your preparation work you like. Representative Russell.
Thank you, Mr. Chairman.
Apparently you've got plenty of time. So.
I'd like to push back a little bit. I think this is, our mission is revenue, and this is one of the first bills going down that road, and it would be foolish not to consider.
I think pretty much.
Do you want a motion, Mr. Chairman?
Yeah, just to carry it over if there is a motion to be had.
Sure, Mr. Chairman. If I could, I would move that we.
Well, she's,
Or Senator Ellis has thoughts first, I'll defer.
Mr. Chairman, I think would help me understand what we're trying to achieve is we have a retail bill, now we have a full corporate income tax bill. We want to vote on the retail bill and then vote to advance the corporate income tax discussion for the next meeting. Are those two separate votes, Mr. Chairman? I'm just trying to sort through how to move forward the best way.
I think that I'm expecting to be cleared up in this motion that's going to happen right now. Let's listen to it.
So my motion would be to substitute the Ellis Working Draft 73 as the involvement of the House Bill 220. I know that came into the interim with some support from Management Council, even though it was not as popular in the Senate. So my motion would be to take up the National Corporate Tax Recapture Bill in the place instead of the evolution of 220, or we'll just call this the evolution of 220.
And continue it on to
To be discussed at our next meeting with the hope or the ask of both the Tax Foundation, other interested members to look at this new draft and say, what are we missing? What needs to be included if we were to do this concept? Not even pushing this concept, but I guess I would we might need to vote to take this on besides the National Retail Fairness Act. Maybe that's the first motion, Mr. Chairman. Regardless if people like either bill, we probably should only have one moving forward. I'm not sure if that's a motion. I don't think we can move them both forward. I mean, we could if that's the committee's pleasure. That might not be mine. So maybe there's a vote in order first.
So I thought your motion to substitute and move it forward accomplishes everything.
It does.
And it gives people a chance to vote no. If that motion passes, it's done. If that motion were to fail, we still have a bill on the table and we could entertain any other motion with respect to that bill on the table. If that's a satisfactory parliamentary way to move forward, let's try it.
So I would move forward with the National Corporate Tax Recapture Bill and substitute it for 220 and not have that move forward.
That would
to the next meeting.
Second. Okay, any further discussion? I'm afraid it's going to be very close votes. Let's just raise our hands, okay? Is that all right? All those in favor of moving forward, raise your hand. I get 7, I think. All those opposed? I get 5. And do we have a proxy?
You do have a proxy from President Connolly that it states to move forward either 220 or Representative Obermueller's bill at the committee's pleasure.
All right, it sounds like it's passed.
Mr. Chairman?
It's absolutely.
Did we have a proxy from Senator?
I've asked him for it and I don't have it. If anybody else has it, and he talked to you before he left.
He did mention he was on favor of either bill, but he didn't really write, I mean, as a aside to me that he had to leave.
So even if he had left a proxy and it was a no vote, it wouldn't change the vote. I understand. I mean, I wish he would have left a proxy. So with that being said, we have this on the agenda for the next meeting. We'll dig more into it. Representative Obermueller, you carried a lot of water on this and we actually depend on you. So even though it's kind of your personal item, it's now become our item. And I hope you'll talk to the Tax Foundation, man. You guys spend some time together. That'd be very interesting. Anybody else? Thank you. Is there any public comment before the end of the meeting? Representative Sweeney.
Mr. Chairman, are we doing anything with the wind?
Well, Representative Sweeney, there's still some stuff coming out from the governor's task force. And the Godby people are going to look at the capacity factor a little bit more. The electricity tax thing, we asked for some information to be done about rolling in property taxes and other things. So I'd say let's gather up information and regroup on that later.
One of the claims to that, that's why I voted no on the gross receipts tax.
Right.
Because I would have liked to have looked at that model over from New Mexico.
Well, let's get some more information and keep going on that. All right. Not seeing any more public comment. Thank you very much. Thank you for all you folks that were online, and we're adjourned. Enjoy the Capitol tomorrow.